Testing audio. Can you hear me? Yep. Great. Well, welcome to 718F. Was Advanced Financial Modeling for Equity and Analysis. My name is Joe Perfetti. I will be the professor for our summer session. So thanks for taking the time to do this. Basically, what I want to cover tonight is just an overview of what we're going to cover during the course and set up some content so that we can get into what we really need to be doing in the next several weeks. So that is the goal. And all of the assignments structurally have been put up. There's some data that I need to add to the assignments as we go on, so you'll be able to complete them. But at least you'll have a sense of what is coming during this class. So just very quickly, we're recording all of these. They will be on Zoom. I actually don't put them on Panopto because Panopto sucks. So all of the classes on Zoom, I will post to YouTube. And I'll put a link on the announcements so that they're easy to find. So either if you're missing something or if you are looking for something as a reference, you can find it there. So that's where the recordings will be. But just really quickly for my own benefit in these online classes, if I can just kind of go around the room, just tell me who you are and any two seconds about yourself in terms of who you work for or where you are in your MBA program. So why don't we start with Chris in the upper left-hand box, and then we'll work around the room.
Sure. Nice to meet you, Professor. I'm Chris Vandermeer. I'm based here in obviously Washington, D.C., but from South Africa originally. Here in the States, working for a company called Ecolab. And online learning is kind of our space, education technology. So I'm kind of on the tech side of that, coming to the end of the first year of the MBA program here.
So if we have any technical difficulties, I'm always coming to you then.
Sure.
Oh, all right. Kathy?
Hi, nice to meet you, Professor. My name is Kathy Kiba. I work for Allied Bank in the capital market investment accounting space. Also coming up on the end of my first year. I'm originally from Chicago. I moved to DC a year ago. So yeah, it's been fun.
Great. Gina?
Hi, I am Gina Hoff. I am with the same group of people that we just talked about. I am also finishing up my first year. I work for a place called Incutel, which is a nonprofit strategic investment firm for the government. And yeah, I think that's all.
Great. Audrey?
Hi, I'm Audrey Cutler. I am in the home stretch of my MBA journey. I work for a global law firm doing operations.
Okay. Is it Isabon? Is that right?
Yeah, my name is Isabon Tom. I'm also just getting through my first year. I'm a budget analyst at the Bureau of Labor Statistics. So I'm definitely excited for this class. Yeah.
Great. Patrick?
Hi, I'm Patrick Vargo, also finishing up my first year. I work for a firm called VSW, which is a data center architect in Rockville, Maryland.
Great. Thomas?
Hey, Professor. My name is Tom McAuliffe. I am the director of FP&A for a local real estate developer, Red Brick LMD. And I am like a year and a half in, so sort of squeezed between Audrey and the rest of everyone else.
Okay. Mike?
Good evening, everybody. So I am Mike Taxe. I am general counsel of an investment firm that actually was formed by the original founder of Incutel. So Gina, we got a chat, swap notes. I've been in sort of multiple variations of multiple programs here. Now I went from the EMBA program to the online to I think this is the right fit for me. So I've been in this program for a bit longer. I have to track out how much longer I have left, but I think I have about a year on my part-time base. So about 3/4 the way through.
Okay, Stephen?
Hi, I'm Steve Anderson. I made the dubious decision to quit my job and try and start a company. So that's terrifying. And yeah, I'm Maryland native. I'm here in Columbia. And I think I'll finish up by May.
Okay, well, hope it works out. Joseph?
Thanks.
Hey, I'm Joe Butkus. Very nice to meet you. I'm first year, just like most of these guys, just finishing the first year. I'm an occupational therapy supervisor at Walter Reed, dealing with mostly poly trauma amputee care.
Okay, Avery?
Hey, I'm Avery. I do FP&A at a small investment firm. I'm with Audrey. I'm about to graduate, so excited about that.
Okay, great. Peter?
Hello, I'm a lobbyist in the generic drug industry, and this is my last course of the program as well, so I'm getting close.
Okay, other Peter? Two Peters.
Hi.
I know we're back to the other Peter Cassell.
Peter Cassell. Hey, good job with the pronunciation. Yeah, Peter Cassell here. This is finishing up my first year as well with a couple other people, and work for the federal government, Department of Justice, doing administrative work, and I'm trying to transition out of that to be a consultant at some point. I enjoy entrepreneurship. I enjoy languages. I enjoy online chess. It's better in person. And I enjoy ice hockey. So glad to be here.
Right, John?
Hey everybody, I'm John Volker. I'm actually finishing up. This is my last class along with derivative securities, so be done at the end of August. I'm from the Baltimore campus and I work for Baltimore Gas and Electric in our technical services department.
Okay, great. Is it Maz? Got that right?
Yeah, so I'm also from Baltimore campus. This is my second year. I think I'll be graduating next year, so still have some classes left to go. And I work for Northrop Grumman, so I'm an engineering manager there.
Okay, Paul?
Hi, I'm Paul. Like some of the folks on here, this is my last class. I'm a second year, living in the DC area. I currently work for Charities Aid Foundation, which is an international grant-making organization where I am a accountant.
David?
Hello, David Steele. I'm a program manager for UMD I-Corps. So we support all the faculty and researchers that want to take their research and turn it into a company. And yeah, I'm about halfway through the program so far.
Great. Is it Ade Tutu? Do I have that right? Close?
Yes. Hi, everyone. My name is Ade Tutu Talabi. I am a first year MBA, planning to convert to MBA MFin, and just finishing up my first year. I am an accountant and a CPA. I work for City of Baltimore Retirement Systems as a senior investment manager, and looking forward to get to know everyone.
Great, thank you. Arun?
Hey, my name is Arun. I am finishing my first year as a part-time MBA student. I usually go to the Rockville campus. I am a software engineer and I work for the University System of Maryland office, or USMO. Our office is in College Park, kind of off Metzerout Road near, I believe it's Courtyards. I don't know if anyone knows where that is. But regardless, I have a huge interest in finance. I'm actually very excited for this. I really would love to combine what I currently do with finance. And so, yeah, I'm stoked, but nice to meet you. And I'm looking forward to it.
William?
Yeah. Hello, I'm Will. Nice to meet you all. I work in consulting, mostly in the technical space. And then this is going to be, like a few other people said, my last class in the program. So excited.
Okay, great. Rachel?
Hi, I am Rachel Andrea. I'm halfway through my first year. I work in government contracting in the finance department, and yeah, excited to learn new stuff. Thank you.
Okay, Isaiah?
Hello, everyone. I'm Isaiah. I'm on my, or wrapping up the first year here, and I work as a business systems analyst at an insurance company called The Standard. But yeah, I'm stoked to be here.
Great. Carlos?
Yeah, hi everyone. My name is Carlos. I am a construction project manager. I work for Jacobs, and this is my first year in the MBA program, DC campus.
All right. And it looks like we have, if I'm going to pronounce this right, Ascletus, who said he can't talk, but gave his little intro in the chat. So thank you for doing that. Excuse me, did I miss anybody? But I didn't. All right. So again, Professor Joe Perfetti, I've been teaching here since 2008. Teach most of the time, I teach applied equity analysis at the undergrad. I do the online MBA version of that, and now doing this. And essentially, that's one of my jobs. I also do a lot of training for companies outside of here. I was just working with Lockheed Martin today, so they're doing Northrop Grumman. So work with a lot of different companies, share some examples as we go through this. And I've been a CFO for division CFO for a company for 18 months. Excuse me. So unfortunately, had this summertime cold I cannot get rid of. So lots of Dayquil, NyQuil. And I also did a venture-backed startup, took 5 years off, raised $39 million, flipped the company. It's called IntelliWorks. We were online applications for colleges, universities to higher ed vertical back in the early 2000s. We were one of the first online applications. We got venture funded for that. So again, a little bit of operating experience, a little bit of academic experience, practical consulting experience. So we'll be sharing some of that as we go through session. Again, we're copying up on tonight. So let's go ahead and start with the syllabus that I put in. And I'm just going to discuss what we're going to be going through in the class. So terms of class, that is my incorrect email address. Fix that really quick. That is my email address. Oh, and my cell phone. I have an office in Van Munching. Well, I will not be this summer since everything is going to be virtual here for the session. If we need to do office hours, I can be available an hour before class time on Wednesdays. Basically, what the goal of this session is to do sort of advanced financial modeling on companies and to understand kind of how sell-side analysts look at companies and to understand kind of the cash flow fundamentals of a business. That will involve, sorry, a few things. One, 50% of the performance of any company is the external environment. So we need to understand that external environment. So a framework to do that, how it will affect the company. I like to say can't drive a car, look in the rearview mirror. So we will look at historical financial statements, but cautionary, it's to help us understand the business model of the company. And the past doesn't guarantee the future. Future performance is more important. We're also going to talk about some valuation DCF techniques for companies and multiple analysis techniques that will apply to companies. In terms of the course itself, expectations. I know a lot of you said this is your last class, but it's going to be a lot of work. So I would expect about 4 to 6 hours a week for each of the weeks this summer, in terms of the readings, the assignments, the group projects that you're working on. For the textbook for this class, I'm choosing the valuation book, 7th edition. by McKinsey, because it's the Bible in corporate finance. If you do corporate finance valuation professionally, this is the book. It's on your bookshelf. It's the approach that people use. So that's what we're going to be using as the basis for our content. Obviously on Homes, I'll post all the materials, lectures, etc., that are necessary. We don't really have a course packet, but any additional supplemental materials for homework, etc., group projects, put in the files section of Homes or group projects. You're going to be working on groups. 40% of your grade is going to be in teams. And I basically put you into teams already. So over here under people, under team projects, these are the 6 teams of the class. Now, I did get an email from somebody saying that they would like to be on a team with some people. So I'm happy to resolve that now. Who wanted to be on a team together? And did you guys figure out which team I had already put you on?
I was the one who sent that email. Could I get back to you with an email on that?
Okay. All right. So here's what I'm going to do, because we can't really have 3 people on a team. It's not enough. We should have 5 to 6. So team 6 no longer exists. And if
Professor, I joined the class late, so I'm not on any of those teams.
congratulations, you're on team 3.
Okay.
So every team now has 6 people. If you guys want to do any trading of teams, we'll need to do that the next day or so before people start working as project groups. But nonetheless, kind of randomly otherwise assigned you to these teams. So if you go to people, team projects, you can kind of just see who your teammates are, and I would start to get to know them otherwise. Unless we're going to use things around. So these are the teams. So 5 teams of 6 people. So in terms of grading, as I said, based on a 100-point scale, 10 points will be class participation. So we'll talk more about in a second. 30% will be homework assignments, which are spread out over 6 weeks, starting next week. And 20% will be an exam, essentially a final exam covering the content of this course, which will be multiple choice and open book. And 40% will be group projects. Hence why it's important to understand who your team members are. There'll be, as I said, cadence is every week there will be homework. And so that homework will be broken out over time. I am going to let you work as partners on the homework if you choose. So basically, I will let up to groups of 2 people work on a homework assignment, submitting together with both of your names on it, or you can choose to work individually. But basically, you can use a homework partner. There's a lot of work in a very short period of time this summer. Some of it's fairly technical. And so if you need to lean on somebody, since we don't have TAs this summer, I'm going to let you guys have the option of homework partners. Right? So, but again, if you do submit an assignment, make sure that you identify who your homework partner is, and then that's going to be your homework partner for the semester. And then make sure you submit both your names of the assignment, and clearly make sure both of you do the assignments. Don't want one person doing all the work and then you just taking credit for it. That will not work out well for you. Okay. So questions about that? If you've done that on your other classes, the ability to have homework partners. All right. Class participation is 10%. Basically, every time you come to Zoom, there's an attendance record, so I'll know whether you're here. Basically, I expect you to generally participate, ask questions, answer questions that I ask, come prepared for the class in terms of doing the assignments and or some of the reading, so that we're not spending too much time just basically lecturing. That's not fun for anybody, and it's not an effective class. In terms of course assistant sites, following university policy, you can't use Course Hero or other sites for previous assignments in previous semesters to help you do the work. You have to do the work yourself organically. Also, you can't use ChatGPT to write your papers. Although I don't think that's going to work that well for you in this class, but regardless, ChatGPT is pretty cool. Late assignment policy is going to be pretty straightforward. If it's late, it's not going to be graded. We're going to take deadlines very seriously. So generally for homework assignments, they're going to be due at 5 o'clock the day of class. So make sure you turn it in by 5 o'clock unless you have a pre-cleared excuse. So if you have a special need or a university approved excuse, make sure you get it in writing from me before the assignment, because otherwise I am going to take the assignment deadline seriously. So if it's not turned in, it's just not going to be graded by the deadline unless you have a kind of a pre-approved excuses. And generally it's going to have to be in writing. So something urgent comes up at work, whatever, you're on a huge project, like somebody's texting right now, make sure you send me an email and tell me, you know, what the issue is, you know, if you need an extension and how much of an extension that you will need. Right? So hopefully that's pretty clear. Relative to your group projects, you're going to be making some presentations on some of the analysis and analytical work that we're going to be doing. One of the other teams is basically going to serve as an investment committee. So 2 people are going to grade you. I'm going to grade your group project, and one of the other teams of this class is going to grade your group project. And so they are going to basically write up a grade and a summary of the analysis of how they think you did. And they are going to run a Q&A session on the work that you present. And then that's also going to be part of your grade. So part of your grade is going to come from me, part of your grade is going to come from other teams in this class. And so basically the investment committee, which runs the Q&A session, one day after the group project presentation, will submit basically a write-up of how they evaluated the team, essentially, which will serve as input into their grade. So that's another thing that we're going to be doing this semester. In addition to that, we're going to do peer reviews of your own team members. So again, group projects generally get group grades. But the group grade assumes that you actually worked with a group on the grade. So if you're not working with your group, you can't take credit for work that you didn't do. So that's the whole point of peer reviews. Peer reviews are to basically tell me, because I'm not there, whether or not you're not sending them to Sarah Cronky, you're actually sending them to me. So about her paragraph. Peer reviews. Basically, this is what we're talking. You will score on a 1 to 5 scale, quality of contribution, level of effort of your team members, and you'll send me an email relative to the group project. And that will be 3 days after your presentations. So again, I'm not giving you a template. It can be very simple email. But if your peers basically give you a bunch of negative peer reviews, say you didn't participate, I'll adjust your grade. So otherwise, everybody's going to team grade. So in terms of grading, the project grades will basically be 70% on presentation and the analysis behind it, 10% on the overall kind of, did you do a good presentation? And 10% is going to be on the investment committee evaluating you. And then the other 10% is what I call teamwork, which is, are you working together? And that's where the peer reviews actually also come into play. So essentially, that would be grading. Questions about that? I apologize for the coughing. You're welcome to read this, but this is what we talk about: class contributions and showing up. this is what I consider to be constructive contributions. So, I believe in the concept of what I call a safe space. And what I mean by that is probably different than many people interpret it. But a safe space, when I work with Google, basically means that people are okay to disagree. And there's nothing wrong with that. Matter of fact, you can challenge me. I don't have any problems with questions, or I disagree, or whatever. Just do it in a constructive way. And that's going to just be important in the way that we run our conversations this summer. The rest of this stuff. Don't do anything that makes me send you to an honor council. Don't do anything that violates copyrights. And this is going to be the cadence of assignments. So basically in week 1, because I got the syllabus up late, there was no homework for this class. Between now and next Wednesday, and we'll have every class every week at 6:25, you need to get the book, start doing some readings, if you haven't already. And any of the editions that are the 7th are fine, online. In fact, the university library has copies. You can check it out for free. So you don't have to pay for it if you can get to it. But anyways, there will be some assignments, and I'll post some data after class tonight that are going to be done in week 2. And there's really 2 things that are going to be done in week 2. You're going to do an EIC analysis, and you're going to do an economic statement conversion, which will involve watching an hour-long video on YouTube in order to be able to do the conversion. And this sets us up for doing historical financial statement analysis. So in week 3, we'll then go through some historical financial statement analysis next week in class, and then I'll give you some data on some companies, and then you'll actually do the write-ups and the analysis for week 3. And then starting in week 4, we're going to get into the modeling. And so we are going to build an enterprise DCF valuation. You'll be responsible for doing that. And then in week 5, we'll then take that model, talk about how we do sensitivities and simulations valuing real world companies, all using real data. Week 6, we'll then get into multiples, and you'll have an assignment doing multiple based comparable analysis and valuation of companies, which will then tie back to the DCF. And then week 7, our final project presentations. So sometime about week 3 or 4, I'm going to let each of your teams choose a real world company that you are going to do these 3 sets of analysis on. You will then take that real world company as a team. You will then do a historical analysis of it. You will do a DCF valuation of that company, and you will do a multiple analysis, a comparable analysis of their multiples against peers with the write-ups associated with that, which you will then present the final day in class. So the final day in class is all team presentations. 6 teams, 3 hours, about 20 minutes per team, 5 minutes Q&A per team. Okay, so that's what we're kind of leading up to. So August 23rd is going to be the big day. Questions, comments, concerns, crippling fears about any of that? Great. All right, let's get into some content. As I said, I posted a lecture note 1, which summarized some of the key themes in the readings of the book, but I want to go ahead and start going through some of this. So one of the themes, and the reason why I chose the valuation book by McKinsey, is McKinsey's in 1,000 boardrooms. And what they've done a good job with this book is it was organized by Tim Kohler, who runs their financial valuation practice out of New York City. And what they've done is they've kind of taken the academic literature and they figured out what is most relevant to the markets. So essentially, they called that the 4 cornerstones of value creation. And so think of this as an overall summary of the themes of the book, right? And we're not going to use the whole book, it's 800 pages. But I've selected some of the relevant chapters to focus on if we're going to actually understand this and how to model and value companies. So very quickly today, I want to give you an overview of some of the things that are going to. Okay? So the first cornerstone is based on the concept of spread. And the idea is you're all finance majors. You know that to have a positive net present value, you have to have an internal rate of return greater than your cost of capital or your hurdle rate. Right? In the real world, we just switch up the terminology, but it's the same concept. And basically, IRR is called return on invested capital. Okay, IRR is the average return on investment of a project over time. Return on invested capital is a 1-year IRR. It's just what's our return on investment this year. Cost of capital, also known as hurdle rate, also known as WACC, is basically an expected return. It's an opportunity cost based on the risk that a company takes. And so the whole point here is that what I like to often say to executives is if you go to a bank and borrow at 6% and take that money and invest and make 4%, what'd you do? Would you borrow at 6 and invest and make 4? And the answer should be no. Okay, because that's the whole point of spread. Spread's the difference between the return on investment, 4%, and the cost of the money that you're borrowing at, 6%. And if you borrow 6 and you invest and make 4, you can't pay off the 6 and you can't create value. Right now, 3 things come out of this. Number 1, those percentages represent cash flow. Okay, so if I say you make a 4% return on invested capital, you're generating 4 cents of cash profit per dollar of investment. If I say you have a 6% hurdle rate, that means you need to make 6 cents of cash profit per dollar of investment to pay the money back. And so what you're telling me is when 4% doesn't pay back 6%, that 4 cents doesn't pay back 6 cents. Okay, and those become interchangeable from a financial concept. We use the percentages as a proxy for cash. Okay, so that's the first thing. Second thing, growth does not create value. And that's a very important thing to understand in finance. Growth does not create value. Here's why I say this. If you borrow 6% and you invest and you make 4, guess what happens when you do more of that? You just dig yourself deeper into a hole. If you can borrow at 6% and invest and make 14%, well, heck, you want to do that all day long. Growth is the accelerant to value. It's like throwing gasoline on a fire. And what really matters is the growth return combination, or more specifically, the growth spread combination. There is good growth, there is bad growth, and we have to separate out the two. The third principle that comes out of this first cornerstone is that half your performance, 50% of the performance of any company is the industry that it is in. The industry is more important to a company's performance from an investor standpoint than the company itself, says Warren Buffett. Okay. In fact, actually, it's what Warren Buffett says. 92 years old, very successful running Berkshire Hathaway. And what he said that served him very well over the last 50 years is, paraphrasing Warren Buffett, I don't invest in companies. I invest in industries. Because if I fall in love with a company in a bad business, there's nothing they can do. If I have an average company in a great industry, they can still make a lot of money. So when he invests, pick the attractive industry, pick the attractive market, not just today, but over time, right? I don't want to catch a falling knife. I want the enduring value creating market. Then pick the company that's going to win in that order, right? Following that investment advice, you tend to do better over time. So again, lots of academic data, which goes back to the days of Michael Porter from Harvard University. Half your performance give or take. Lots of academic studies have been done, and they're all around half performance, is the industry or market that you are in. Okay, marketing strategy, red ocean, blue ocean. I don't want to invest in a red ocean. I want to invest in a blue ocean. Are you guys familiar with that terminology? What's a red ocean?
Would a red ocean be saturated with competitors?
Yeah. But what, do anybody know the metaphor for red ocean, like where it comes from?
I can take a stab at that. I don't quite, are we doing hands?
We're small enough. Just go ahead and take the stab.
I remember the page in the textbook. I would think it's from overfishing or just, I mean, it gets blood from fish in the sea. You just, red ocean versus a blue ocean is full of new fish or whatever.
Yeah, it's the red ocean's filled with blood. There's sharks swimming around. You know, there's piranhas out there. You're trying to fish. Right. Blue ocean is Forrest Gump after the hurricane. You're the only shrimp boat out there. Easy to catch all the shrimp. That's the point. I don't want to invest in red ocean. So, you know, I'm working with Penn up in Hospital University of Pennsylvania, up in Philadelphia. And the problem is in the Philadelphia region, zero population growth right now. Philly and that whole mid-Atlantic area, not growing. So your hospital, and you want to attract more patients and grow to your hospital healthcare system. Well, if you want to grow 5% a year, the patient population is not growing, you basically have to take away share from another hospital. So Penn has to basically take share away from Jefferson if they want to get more patients coming to Penn. Well, that makes them much more competitive. You are in Austin, Texas right now, patient population is growing 8 to 10% a year. So you want to grow 5%, there's lots of new people that are coming to Texas. So you don't have to go fight with everybody else to go get those patients. I'm just saying that's a bluer ocean than Philadelphia, which could be a red ocean. And in that red ocean, I say you can't do it, but it's going to be harder. It's going to be less profitable, right? And that's the point. I want to know what my market opportunity is and what the competitive dynamics are in that marketplace. That's going to have a big impact on profitability. Make sense? Questions? Ten Commandments, Charlton Heston. I guess that's one way of looking at a very unhappy seat. All right. So, do you guys have access to Bloomberg at Maryland? Have you used Bloomberg? Have you seen Bloomberg? Do you even know what it is? Okay. This is a Bloomberg terminal.
Yeah.
Right? If you work in finance, this is the Pro Tool. This is the software that you use, right? So this is what the banks use. This is what the fund managers use. It is a very powerful tool. It's got 1.4 million companies in its database, real-time information. It's a news service, data service, trading service, a lot of information here, okay? So we have 60 terminals at the University of Maryland. And so they're very helpful if you can get access to one of these. I believe there should be a few in each one of the campuses if you haven't had access. They're free for student use. Otherwise, they cost $25,000 a year. So take advantage of it while you're at the school.
There's no student discount on that?
Actually, there is. Bloomberg will give an academic discount, which is buy one, get 3 free. So believe it or not, the school spends for 15 licenses, which is about $300,000 a year, and we get 60 terminals. But we still spend $300,000 a year. Matter of fact, we are the, I think, first or second largest academic license in the world. Like they don't have this many terminals at Wharton. They don't have this many terminals at MIT. Like we have the most in the US. As a matter of fact, at Van Munching, we have a teaching lab with 32 terminals. But in any event, this is the online MBA. You guys aren't physical. So back to this. Give me a publicly traded company. Any publicly traded company anywhere in the world.
Novavax.
Novavax? Right? So one of the nice features of Bloomberg, it's a keyboard-based system, RV, is it does real-time benchmarking. So this would be the default peer list for biotech Novavax that Wall Street, analyst curated, actually uses. Now you can customize the peer list to your heart's content, but this would be the default list of Novavax peers that Wall Street would start with. It's got all this data. One of the nice features of this tool is you go to custom and you look at any data point that you want. So the data point that I'm going to look up is called ROIC, return on invested capital. And what I'm going to ask the tool to do is to give me the ROIC as of the latest filing. So assume March or June, at this point even, 2023 annualized. What's nice about the tool is the top row is the industry average. And it's a market cap weighted average, which means it's adjusted so some teeny tiny company doesn't distort the average. Novavax, first row down. Then I'm going to put in something called the WACC, the weighted average cost of capital, which is calculated in real time today. Top line again being the industry average. So the concept of spread is this is what this group of companies is borrowing at and is expected to earn on an annual basis, 9.4% right now. In the last 12 months, if I gave this group of companies $1, they lost 55 cents. Okay, so this would not be a very financially attractive industry right now. Okay, but nonetheless, that's how they're doing. And the whole point is these biotechs probably don't generate a lot of revenue. They're probably mostly spend. They're very early stage, even though they're publicly traded. But at the same time, no one's really making money in the early stage basis. They're not generating a lot of profit. And that's the whole point. That's what the industry is. Now you see some variation of cost of capitals, but they're all pretty much, most of them are, within 1 or 2 points of the 9%. And that's the idea. There is sort of like an industry level of risk. Okay. I'm going to save this template, but I want you to give me somebody else.
Tesla.
Somebody that's actually making money. All right, Tesla. Thank you. Or at least Tesla's making money. I'm not so sure about Twitter anymore. All right, so this will be global auto when it loads, which will include the electronic vehicles. How does this list look? How's this industry? Is this an attractive value creating industry?
Yeah.
How do you know?
Positive values, you don't see anything negative in the ROIC.
Yeah, but how do you know it's an industry that's attractive?
The ROIC tends to outweigh the WACC.
The 13.49 average is greater than 10.57. This is IRR. This is R. Positive NPV, positive value creation. All right. That's the way I want you to start looking at this. Second point, in this class, you will use numbers. I do not grade general statements positively. Okay. That's for English majors, right? It's a finance class. You will use data when you answer questions. So therefore, don't just say, oh, this is an attractive industry because it has a positive spread. Problem with that statement is that you're going to be right 50% of the time. Okay. That doesn't mean you knew what the right answer was. If you tell me that the industry has a cost of capital of 10.5% and ROIC at 13.49, then I know what you're talking about. So going to be very important to use numbers this semester. But that's the numbers you should be looking at. And this is a value creating industry. How's Tesla doing?
They're doing great.
So that's the point. Tesla's doing really well in a good industry. This is what we would call competitive advantage. In this class, we will define competitive advantage as outperforming peers. So you can create value, not outperform your peers, and basically you're just in a good market. You're really good, you outperform your peers. So relative spread compared to the industry average is how we are going to define competitive advantage. Tesla would be demonstrating competitive advantage. What about Ferrari? Competitive advantage, yes or no? Does Ferrari
I
get
would
it?
say yes, right? Because they're as a percent of WAC doing even better.
Yeah, they're doing better spread than the market. What about Kia? Is Kia creating value?
No, well, they're creating value, but because they're, but it's, less than 1 point. It's 0.42%.
So yeah, so they're creating value. But do they have competitive advantage?
No.
Not that to give the definition I just gave you. So what I would say is, you know what? Kia is probably doing okay because they're in a good market. Kia is not doing great because they're really separating themselves from their peers. Okay. Now don't get me wrong. You go talk to a company, no matter how bad they're doing, everybody thinks they're good at something. Okay. So we are going to use a more technical standard here for defining competitive advantage. Attractive industry, positive spread. Value destructive, unattractive industry, negative spread. Competitive advantage, outperform your peers. Okay. Now, here's what's interesting. This is Tesla. Tesla is doing really well, and Tesla's pretty big from a market cap standpoint. I'm going to take Tesla off this list. Ironically, that is Ford's peer list. Ford's peer list does not include Tesla as a competitor. I don't know why, but Wall Street doesn't consider Ford and Tesla to be simpatico. I want you to look at traditional autos and tell me what you think about that market. Is that good?
Not good.
So that's the thing. Take Tesla off the list, and traditional auto right now is a real tough business. Are there outliers? Is anybody doing really well in the traditional automobile segment?
Ferrari.
Okay. So yes, there's an outlier named Ferrari, but that's the point. As an investor, I don't want to hope that I just get the outlier when I put my money at work, right? That's a tougher business. I want easy. I want lots of companies that do well and then pick the one that's going to do better. And that's the point. That's Warren Buffett's philosophy. So Warren Buffett wouldn't be that excited about the automobile industry because the average automobile company, not creating value. This is a tough business right now. And that's different than some of the other industries that we might be looking at. Is that kind of seeping in with everybody, making sense? Give me somebody else.
I mean, I'd almost argue you could say Ferrari isn't really an auto company at this point because I want to say I read they sell more branded merchandise than they like in dollar amount than they do selling cars. So they can only produce like 7,000 a year.
So they're almost like a lifestyle brand, kind of like Nike in a way.
Yeah. They make more money off their F1 fans than they do off of their vehicle sales.
But either way, they are an outlier in a tough business because the core business is just really tough. And I'm just saying, most of the automobile makers, even BMW, Mercedes, they can't get past that. Right now, give me somebody else, different company, different.
How about Hilton?
Hilton?
Yep.
The hotel company?
Yep.
So let's look at travel leisure. So first, industry. How's the industry for global hotels look? I'll sort by size. Bigger ones near the top. Is this an attractive industry?
No.
No.
But here we see more variation. We see a couple firms like Marriott, which are doing really well. Hilton's actually doing pretty well. And we see a couple of firms, Royal Caribbean, for example, floating hotels, and to some degree, the Expedias of the world, or even the Hyatts, not doing so well. So a little bit more variation in this industry. But when you put it all together, it's a tough industry. And that shouldn't be a huge surprise because coming out of COVID, travel fully hasn't come back. And it's getting back. 23 is probably going to be a different year. But this is still 2-3 quarters of 2022 in the data that we're looking at. And it was a tougher business last year. As if we were to look at airlines. Like let's say I threw Delta Airlines up here. You think the airlines did well last year or not? Well, they have
Not well, but they're coming back, right?
One
They're
was
booming now. They're booming now.
last year's tough, and two, $120 oil prices for a good chunk of last year, and 25% of an airline cost is fuel. So most of the airlines, these are global. Switch to US just to keep it a smaller list. Service US. A global airline didn't do so well. Well, that small Indonesian player seems to be doing pretty good. But they probably didn't care about COVID anyways. But that's the point. None of the big airlines in the US really did that well last year, and that shouldn't be a surprise. Tough industry, hard to differentiate yourself from that fact. Okay. Versus, how do you think pharma did? We looked at biotech. What about pharma? People like Pfizer, Lilly, Merck.
In the last 2 years, very well.
Why do you think they did well?
The vaccine.
Part is vaccine. But the farmers are doing really well, especially as a group. And the real reason, it's called patents. They make a lot of money when their drugs are under patent. Novo Nordisk, we know what they sell?
Insulin.
Ozempic. So insulin, yes. Ozempic, Wegovy, all the weight loss craze drugs, that's Novo. It's all patented. Or you buy stuff online, you're buying counterfeit drugs. Otherwise, it's $1,000 a month. So I'm just saying, these companies as a group, there's reasons why they do well, but this is generally in a more attractive industry. And you don't really see anybody losing money in this business. A couple companies aren't doing well, but they're the outliers. Most companies doing really well. That's my point. Apple. How do you think tech hardware does?
Professor, how far back does the data go for this?
Far back as you want. This is just last year, but you can go back as far as you want.
I guess I meant, sorry, how recent is the data? So,
This is as of the latest filing. So would be through March 23 annualized or June 23 if it's been released.
thank you.
So, but again, I can change any time period frame that I want. But the point is, how's Apple doing?
Great.
And again, most of the companies on this top of this list doing really, really well. So automobile companies didn't do well. Semiconductors, how would they do? Companies like NVIDIA. The point I want to make, different industries have different levels of attractiveness, different levels of return. Therefore, different levels of cash flow, right? And that's the first cornerstone. These companies are going to be more valuable with these types of returns than the automobile industry, because 16%, 16.35 cents per dollar of cash generated is worth more than a 4% ROIC, which is 4 cents per dollar of cash generated. Okay. And that's the first thing you need to start to understand, is that eventually whatever cash you earn internally will be the cash that the company is eventually worth. Right. because that's the law of one price, right? And that actually plays out over time in the real world. Okay, so that's the first cornerstone. Does that make sense to everybody? Okay. Here's what we're going to do. I need to take some cough medicine. So we're going to take a 5-minute break. I'm going to pause the video and we will come back at 7:30 and then continue on with this conversation. All right, we're back. So before I go forward, questions about anything so far?
Professor, where is the link to the YouTube video, the 1-hour YouTube video you were referring to earlier?
I need to post it. Haven't
Oh,
posted.
okay. Thanks.
I need to post it with the file that you have to work on, which will come up probably while you're working on a little exercise a little bit later. All right.
You know where we can find the book too?
Easiest place is Amazon. But as I said,
You want the physical book?
ebook is fine. You can use the physical book, you can use the ebook. As I said, I know the Maryland Library actually has a few copies of the book that you can check out if you don't want to buy it, if they still have them available. But, and like I said, you teach 170 students a semester. So there's a bunch of used books floating around. But the key is 7th edition. Don't buy an earlier edition. And Audrey just said the library has an ebook too, so that might save you guys some money as well. But 7th edition, don't get an earlier edition. Back to the cornerstones. Number 2, about cash, not income. Okay, you guys are finance majors. Net income is like pay stub. It tells you how much cash you're eventually going to generate, but it doesn't tell you about the cash that you have in your account today. And cash is far more important than income. And the other reason is time value money. When you get the cash changes its value. So in finance, we tend to track cash, not income, even though income is a proxy for cash. And cash flow tends to be more predictive of value. Third, it's about the future, not the past. Okay. Problem with everything I just showed you before we took a break is we were looking at last year. Okay. And companies are worth the sum of their future cash flows, not their historical cash flows. And that's the importance of the third cornerstone. It's all about the future. Okay. That's what won the people at Chicago a bunch of Nobel Prizes in economics, is what they showed with big data sets, initially over 50 years, now over 90 years. When you look back with big data sets with lots of companies and lots of different types of assets over long periods of time, which tend to see as a 1-to-1 correlation between cash flow and price. Whatever cash the assets generated became their price in the real world. That's what we call intrinsic value, right? Because otherwise there's an arbitrage opportunity. So it makes sense that your cash that you generate, that you give to the owners, will eventually be the price that the owners pay. Your cash equals price. But it's your future cash flows, not your historical cash flows. That's why using Yahoo Finance is a waste of time, okay? Because what Tesla did last year in 2022 is not what is important. It's what Tesla's going to earn in 2024. I care much more about that. And if 22 doesn't tell me what 24 is, then I'm not going to understand the true value of a company. So future cash flows matter. Expectations of those cash flows matter. Because again, back to Warren Buffett, in the short term, stock prices are voting machines. In the long term, stock prices are weighing machines. Today, I guess what the cash flows are going to be. Then when the data comes out, I adjust. Okay, so short term, guess the price, guess the cash. Long term, adjust to the actual cash. But here's the rub. We never get to the long term. Like one of the things that's going to be important this semester is when we forecast a company, the next 10 years of cash they generate is going to be the most important part of your forecast. So tell me how much cash any company is going to generate the next 10 years. You're going to be doing that. Okay. Then 10 years from now, we'll look and see what the cash the company actually generated is. Price should tend to work towards that. The problem is if we go in a time machine 10 years from today, the last 10 years don't matter anymore. It's the next 10 years. So I'm going to give you an always in finance. Price is always expectation. That's actually why you can't beat the market. Right? Because the problem with being the stock market, it has nothing to do with the company's performance. In the short term, it has everything to do with performance against expectation. And that's the point. What are the expected cash flows? That's what you're going to trade at. And that's what's very, very important. That's why tools like Bloomberg can be useful, because if nothing else, they can show us what the expected cash flows are. So assume you guys all know this, but in case you don't, in the real world, let's say we're looking at NVIDIA as an example. There are two types of analysts. There's a group called the buy side, and there's a group called the sell side. Does anybody know the difference? Say buy side versus sell side?
It'd be a call versus put side.
No, it's a good guess, but that's actually not the difference. So in the real world, this is NVIDIA, the buy side analysts are the owners. They're the people who actually own NVIDIA stock. More specifically, the institutions hire people like you, MBAs, to basically do analytics using the frameworks that we talk about during these sessions to pick stocks. That's called the buy side, because they're literally buying and owning the stock. And one of the nice features of Bloomberg is, from an investment standpoint, investor relations uses these. It will give you, for any publicly traded company, based on SEC filings, it'll give you all of the institutional ownership of a company. So this is for NVIDIA, 72.87% of NVIDIA shareholders are institutions on this scrollable list. As of right now, their largest shareholder is Vanguard, which owns 205 million shares of NVIDIA, which is 8.3% of the company. Their second largest shareholder is BlackRock, which owns 7.4% of the company. The third largest NVIDIA shareholder is FMR, which is Fidelity, which owns 5.5% of the company. Their top three shareholders, buy side, 8, 15, 21. Their top three shareholders own 21% of NVIDIA, right? These people are very important to NVIDIA because, number one, you can see that when they trade stock, they don't trade like 3 shares on Robinhood. Like, these companies are doing big trading blocks, which means they are the price setters. They also are the ones, because they own big blocks of stock, that vote on the board. So they're very important in terms of who's going to be on the boards of these companies, right? You want to not piss these people off because they are the owners of the company, because that's the point. In today's world, we have put our money into the hands of institutions, which are basically buying on our behalf, and they are using the principles we talk about in this class to basically understand value of companies. That's called the buy side, right? So that's what we mean by buy side. In fact, when a company has an earnings call, there are 2 calls. The first call is with the next group of people called the sell side. And then the second call a company will have is with their owners. It's with these people. And that call is very important because you're going to get your top 30 shareholders and you're going to tell them what happened in the last quarter. And you don't want them to go sell because that could really affect your share price. So this is called the buy side, right? But the challenge that the buy side has is, let's say I'm BlackRock. I am a fund manager at BlackRock that has NVIDIA in my portfolio. But my fund at BlackRock that I manage might have 100 companies in it. So the question is, as a fund manager at BlackRock, how do I keep track of 100 companies and all their industries and all their competitors on a daily basis to make sure that I am trading effectively? And the answer is they can't. Too much information is going on. So what Wall Street does is it spends $4 billion a year on research to a group of people called the sell side, who are the consigliere to the buy side, to tell them what to do with stock. And these sell-siders are specialists. And right now, these specialists work for banks. And for NVIDIA, it's specifically these 57 people. Okay. Now, NVIDIA has a lot of people that are covering them. Okay. But they are banks. You can see them. It's Thiago, can't pronounce his last name, from Itaú. It's Toshiya Hari from Goldman Sachs. It's Atif Malik from Citi. Stacy Rasgon from Bernstein. These are the people that write the buy, sell, hold opinions, right? And basically what happens is I am a sell side research team that works for a bank. I am Stacy Rasgon of Bernstein. And so basically BlackRock hires Stacy from Bernstein, pays money to say, what should I do with NVIDIA? And she is writing equity research and basically creating a buy, sell, hold opinion, as well as a 12-month target share price where she thinks NVIDIA will trade. And based on that information to her clients, people will then use that information to buy or sell. And if Stacy is not good at telling the clients what's going to happen, they will fire Stacy and they will go work with another one of these people. So it's very competitive. Now in Wall Street, the typical sell side team is 3 people. It'll be the analyst, it'll be an MBA in finance, and it'll be an undergrad in finance. And they will be specialists in an industry vertical. So taking Stacy as an example, I click here. Stacy's team at Bernstein has a coverage universe of 10 companies. As a sell side research team, they decide how many companies they want to provide research on. So they self-select. Most Wall Street analysts do between 10 and 15 companies. Her research is actually 10 companies. Okay. So their life working for Bernstein is basically to know all they can about those 10 companies, all tech, semiconductors, and basically write research on them, buy, sell, holds. You can see their actual research right here. If you click on research, this would be all the research of Stacy's team on Bernstein for NVIDIA. Do you notice that my screen is blank? Do you know why my screen is blank and I don't see any of Stacy's research?
Do you have to pay for it?
Exactly. I don't pay for the research. I don't see Stacy's research. You pay for the research, shows up right here. Okay. Now, Maryland actually, through its Bloomberg license, gets access to JP Morgan in its research reports. Okay. And sometimes they're good, sometimes they're not, but they're a good bank. So we have those, but we don't pay for Bernstein. We don't pay for Goldman. So we don't see their reports. Now, here's the other thing. Stacy's team, you want to see Stacy? Stacy's actually a guy. He is on Bloomberg right now. That red dot means he's logged in the terminal, but offline. So he stepped away. That is phone number, works in LA, 1999 Avenue of the Stars. That's contact information. A little brief LinkedIn profile type of a thing. One nice thing about Bloomberg, 340,000 users. It's an amazing Rolodex. You have real contact information for all of the world's financial professionals. And because they use the data service, if you talk to them, at least the first time before they block you, they will probably respond to you. And then when they realize you're a student, they may block you. But as I tell my students, if I'm looking for a job on Wall Street, this is actually everybody working on Wall Street. And you know how to get in touch with them. And there's 2 ways to get a job. If you want to put in the work, you might get 19 no's. The one yes would be beneficial. Anyhow, separate story. PIOP, by the way, Bloomberg code for that, for people. But Stacy used to work at McKinsey before it was at Stanford Bernstein. She probably knows, and as a doctorate in chemical engineering from MIT. So that's the point. These are the specialists that Bernstein hires to understand semiconductors. That's his team. So back to this, what does Stacy do? Two things. One, Stacy's team writes the buy, sell, hold opinions. What do I think is going to happen in the future? They upload their buy, sell, hold opinions. As of today, 50 of these people call NVIDIA a buy. Buys are worth 5 points. 6 of them call NVIDIA a hold. Holds are worth 3 points. One says sell NVIDIA, too high a price. Sells worth 1 point. On a 5-point scale, looking at their future, analysts today call them a 4.67, and that average has been going up at the last 30 days. They're very bullish on NVIDIA, right? Second thing they do is they all predict where they think the share price is going to be in 12 months. It's called a target share price. That is something you're going to be doing this semester. What do I think the company is going to trade at within the next 12 months? These are their current guesses. Bloomberg takes a wisdom of the crowd approach. It averages all the target guesses. The average Wall Street guess is 471 a share. Today, they closed at 439. The market thinks there's 7% upside in the next 12 months. Their share price has gone up 191% last 12 months through today. So the point is, in the short term, NVIDIA stock is way up. They don't think in the short term it's going to go up that much more, but they still like them long term. Everybody know why NVIDIA stock has gone up so much?
Isn't it because they make the chips that AI needs?
Exactly. Is that once we got past Chat GPT and we're like, all right, you need the tech stuff to actually power the clouds for the AI, NVIDIA's chips are powering the clouds for AI. And so when everybody realized that, their stock price went to the moon. Okay, so here's the other thing that they do. They forecast the cash flows of all the companies they cover, independently of the company. They're called models, MODL, in Excel. You're going to be doing this. By the way, when they forecast the models, which is why this is called advanced finance, they don't just forecast revenue. They forecast data center revenue. They forecast gaming revenue. They forecast automotive revenue. These are then summed up. How do you forecast data center revenue? How many data centers are they selling to? What's the average selling price to a data center? How many chips is a data center buying? There's granularity to these forecasts, which are based on understanding the metrics of a business. So that's the point. These are their forecasts. And they actually upload them and share them. They're locked, you got to pay for them, but Bloomberg aggregates them. And they forecast them for multiple periods. So this is a forecast for NVIDIA by the market going through 2027. This is 23 actual. The fiscal year ended in January. These are the next 4 years for NVIDIA. Their revenue last year actual was $27 billion. So top line sales. Their revenue by 2027, $86 billion. Their data center revenue last year, $15 billion of data center sales of chips. By 2027, $70 billion data center chips. Gaming, $9 billion to $15 billion. Automotive, $900 million to $3 billion. OEM, who cares? Professional, whatever. This is where the action is. Okay. And this is what the market started to understand as we talk about all these AI technologies and investments in the cloud. This is the company all the cloud players are paying all the money to for their chips, not Intel. And this is why historical financial analysis fails. Look at 2022 and look at 2023. Extrapolate that out as a company. Sorry, these two ones. 2022 revenue, 2023 revenue. And you tell me with that historical trend, you're going to extrapolate that number out. You're just not. And I'm just telling you, this is what the average investor misses. Because they don't have a good view of the future cash flows of what companies are going to do. Now, if you're dealing with a company that's stable, it's mature, it's growing 3% a year, it's been going 3% a year forever, it's Verizon, and they just can kind of like, put it in without doing a lot of effort, and nothing's going to change much at Verizon in the next few years. Historical financial analysis works really, really well. But you're doing NVIDIA and you do historical financials, you're going to misunderstand why the market is liking that stock. And this is what we in this class have to get good at. Questions? This is the third cornerstone. It's about the future. And it's those future sales and those future profits, which are summarized here. Those future sales and those future profits generate those future cash flows, which go from 4 billion last year to 31 billion a year by 2027, which when you discount those cash flows, gives you that share price. Somebody's got their hand up. Is that Chris?
Yeah, question, Professor. I guess this is the point of the class, but how do we get to that level of granularity? Like if I imagine these analysts have like really good relationships, and they obviously have very broad and deep industry knowledge that helps them to generate, these relatively accurate numbers. How do we get there? And I guess just for this class, like what sort of, I imagine you'll probably provide us some proxy data or something like that, but just, how much depth do we get into?
So the sad thing is that, again, because of the nature of the online class and you're not physically at College Park, it'll be harder for you to access the terminals to do some of the things that I'm showing. All right. However, what we're going to do over the next 6 weeks is what I'm more concerned about is getting you to understand the process. All right. And we will use a couple of companies to proxy this process out. And I will give you some data to help you follow the process or ask you to go get some data on the process. But the point is that you just can't go get a company's annual report or go to a historical site to do the real work. You're going to have to eventually start to understand how to create a forecast. And so we will be working on that with some companies. And so as I said, this is as much about understanding the process than answering the question for companies, but we're going to do it in the real world setting. Like when we do the homework assignments, we're going to do it on real world companies. So that's how we're going to handle this. And again, if you get access to the terminals, great. Unfortunately, we can't, zoom into the terminals. You have to physically be at a terminal to use it. Bloomberg does not allow online use of its terminals for IP reasons. Other questions about any of the content? Does it make sense? This is expectations. Right. Fourth cornerstone. Baltimore should have a terminal. So we asked about that. All the remote campuses have at least one terminal. And they're free to use as students. So back to this PowerPoint. Fourth cornerstone. It's about what I'm going to call sustainability of competitive advantage. And the whole idea is, does a company have a competitive advantage? But here's the key. If so, for how long? Darwin is at work. Nothing lasts forever. All advantage is transient. All attractive markets eventually start to come to an end. All companies that outperform eventually either go away, get disrupted, start to become more average. So the real question is not, does a company have advantage? We're going to answer that one. But how long? How long will that advantage last? And that's going to be important to our valuations, right? Because we'd love to have enduring advantages, but realistically, that doesn't exist anymore. So, but having more advantage faster or longer still has some value. So we need to understand that. How attractive is the market for how long? Does a competitive advantage exist? And then how long will it be? So that's kind of what's the fourth cornerstone is all about. Question or comment in the chat to monitor these. Email the IT rep, they can get you access. Like I said, real easy to do. All right. Continuing on. Beneath the four cornerstones are what the book calls key value drivers, KVD for short. This is the math. What I've done on this one slide is I've summarized all the math. Okay, so this is what the equations tell us matters. And we've been talking about this. At a high level, it's three things. One, what's your ROIC versus your cost of capital? IRR versus the R. Second, how fast can you grow that spread? Third, how long can you sustain it? How long can you sustain an ROIC greater than your WACC? How long can you sustain a growth rate before it goes flat or you go away? Okay. Now, ROIC is a function of two things: your profitability, how much you make, and your productivity, how much you have to invest to make it. So 5 things come out of the math, and those are called key value drivers: margin, profitability, productivity, how much you invest to generate the sales, risk, which is cost of capital, growth, and sustainability. Those 5 things are the most important things to the valuation and value of any entity or any company. So that's what we will focus on when we do our valuation. That's what we have to model. That's what we have to understand. That's what drives operating method. To get technical. Okay, and this covers some of the readings that you'll be doing in the next week.
Can we go back for a moment? You said productivity. What do you mean by that exactly?
So productivity, which we'll get to when we talk about the ROIC drivers next week. But let me preview it with some data to illustrate a point. Open up this file. All right. So if you can see this. Can you see this file that says benchmarking case? This is some benchmarking data for 2022 on the defense and aerospace industry. Okay. This is the type of thing that we're going to be getting into with financial statement analysis next week. Okay. But I want to compare 2 companies. One, I want to compare Lockheed Martin against a company called Raytheon. Okay. So a lot of data on these slides. Okay. So what I'm going to do is I'm going to blow it up. This is return on invested capital pre-tax for what company is this? Lockheed Martin. Last 5 years. About 30% a year. Can you see those numbers? Okay. Return on investment, as you will learn, is a function of 2 things. The EBIT margin, EBIT divided by revenue, profit margin from operations, times how much capital is invested in the balance sheet to drive sales. So the way to think about this is in 2022, Lockheed Martin made a 31% ROIC. How did they make it? They had a 12.7% profit margin when they sold a product. So they made about 13 cents of cash profit. To generate $1 of revenue, Lockheed Martin spent 40 cents of balance sheet to generate $1 of sales. Okay, so return on investment, profit divided by investment, 31%. they're making a 31% ROI because they got to spend 40 cents to generate a dollar of sales. And they make 13 cents when they sell that dollar of sales. That annualizes to a 31% ROI. Just keep it simple. Everybody follow that so far? All right. Here is Raytheon. Raytheon makes an 8-cent profit margin. It's Raytheon, sorry, 8-cent profit margin. But to generate a dollar of sales last year, because they did an acquisition with United Technologies, they spent $1.60 of balance sheet to generate a dollar of sales. Their return on investment is 5%. What's more attractive? Would you rather make 5 cents per dollar? Or would you rather make 31 cents per dollar? Why does Lockheed Martin make 31 cents per dollar? Is it because they're more profitable? No, it's because they invest 1/4 as much, 25% as much, 40 cents. Raytheon has to spend $1.60 to generate the same sales. So Lockheed Martin is spending 40 cents on their programs to generate sales. Raytheon is spending $1.60 on their programs to generate sales. When they sell the product, Raytheon makes 8 cents. When Lockheed Martin sells its product, it makes 13 cents. So Lockheed Martin is making more in every sale, and they're doing it with 25% of the investment. That is far more financially attractive. Value drivers, 2 of them. How much cash you generate from your income statement, that's your margin. How much cash you reinvest in your balance sheet, that's your productivity. Does that make sense?
It does, thanks.
You will be doing all of this in the next 7 days. That's what we're building up to. That's the video for the homework assignment, so you can do this on companies, right? We're gonna have a very detailed way of analyzing operating performance for companies. That's what we're gonna be focused on. All right, so back to the technical stuff that gets us to that point. Okay. Starting out with a hypothetical company. Hypothetical company makes 100 million a year of operating profit. The acronym is going to be called NOPLAT in the book, or NOPAT in the real world. NOPLAT stands for net operating profit, or EBIT, after tax. Or NOPLAT, net operating profit less the applicable taxes, or less the adjusted taxes. Okay, so it's your operating profit after tax. And the reason why we do it after tax is because you have to pay the tax before the investor gets the cash flow. So hypothetical company, 100 million of NOPAT or NOPLAT. 50 million of the operating profit is reinvested in the business. 50 million in this example is paid out to the investor. That creates 2 additional ratios: the reinvestment rate and the payout rate. The reinvestment rate is the percentage of the profits reinvested in the business, 50%, 50 divided by 100. The payout rate is the percentage of the profits that are paid out to the investor. 50 paid out to the investor, 50%. Reinvestment would be things like capital expenditures, investments in working capital, inventory, accounts receivables, etc. Returning to investors payout, stock buybacks, dividends, pay off the debt. Okay, so that's the point. When I make a profit, I can do 2 things with the profit. I can either put it back in the business, or I can give it back to an owner, right? I choose how I give it back to the investors. Different ways to pay it out. It's all payout. I can choose how I can reinvest in the business, but still invest in the business, either reinvest the profit or pay it out. Those 2 ratios, the investment rate and the payout rate, have to add up to 100% of your profits. In this simple example, half your profits are paid out, half your profits are reinvested. Okay. Defining two more things. Sustainable growth, also known as G, and free cash flow. We'll start with sustainable growth. Sustainable growth is the rate at which a company can grow with internal funds. That is known as the sustainable growth rate, or the G of a company. So in this example, we have this company which makes 100 million a year and reinvests 50. Let's say it makes a 10% ROI. It made 10% in the past. It's going to make 10% in the future. Just keep the math simple. So if they reinvest 50 million, 10%, they're going to get 5 million of new profits. Okay. So here's how I can mechanically figure out the growth of this company. If they keep making 10% and 100 million in year 2, they're still going to make 100 million on their core operations. If they reinvest 50 million at 10%, they're going to get 5 million of new profits. Next year, their profits are going to be 105 million. They will grow by 5% from 100 million to 105 million. That's just the math of these bullet points. The shortcut for the math is G, the growth rate, is the rate of reinvestment, the 50%, times the return on that investment, the 10%. I reinvest 50% of my profits. I make an ROI of 10% on those profits. 10% of 50% is a 5% G. Investment rate times ROI equals G. That's the formula. So that's the point. I could do the mechanics of the 5% here. I could actually just use the formula to solve for 5% here. Everyone with me so far on the math? Question. If I want to grow at 10% a year, not 5% a year, how does this company do it? If they want to crank up the growth rate, how does this company grow faster?
Increase the reinvestment rate.
To what percent? Say I want to grow 10%. What does the reinvestment rate have to change to?
100 million.
100%. It go to 100%. What would my payout rate be? If I went to 100% reinvestment, what would my payout rate be?
You'd pay out none in that case.
Yeah. And I might have some very unhappy investors who suddenly are like, well, remember that dividend? I got to suspend it because I'm putting it all back in the business. So let's say I don't want to cut the dividend. I don't want to change the payout rate. How else could this company get to 10% G?
You could borrow.
Let's say I don't want to borrow. How else could this company get to a 10% growth rate if I don't want to pay out? Don't want to change my payout. There's a second option.
Lay off, I guess, say lay off people or don't in other areas.
And that would change what?
Well, you'd have more cash. They don't have to pay to employees, so you could. Oh, that's not growth. Never mind.
By reducing expenses.
So here's the real point. Look here. If you reduced your expenses, your ROI would go up. What would the ROI have to be to get a 10% G? If I reinvested 50%?
20%?
20%.
20%. That is fundamental, and I need you guys to understand that. There are two ways to generate growth, sustainable growth for a business. One way, you can just throw more money at the situation, reinvest more money. Okay, one way I can go grow. The second way a company can grow is have ROI that's very high. Because that's the point. When you generate a high rate of return, you're good at what you do, you make a lot of money, and you don't need to borrow money because you can actually use that money to fund your internal investments. The opposite is true. When you have a low return on investment, the only way you can do high growth with low ROI is you have to invest a lot of money. Well, that's the problem. If I have low returns on investment, the rule in banking is to lend money to people who don't need it. And so when you need the money, it's going to get expensive. So it's the poor performing companies that have low returns on investment that have to throw lots of investment in order to grow. And that's a tough time from a valuation standpoint to want to borrow money. The opposite is true. When companies have high ROI, everybody wants to lend you money, but you don't need it because you generate such great return on investment that you can self-fund your growth. And that's going to be fundamental as we start looking at valuation. Someone's got a hand here?
Yeah, is there any difference between return on new investment and the IRR, or are those just interchangeable terms?
Fairly interchangeable, but the key is that it's the incremental return. Meaning, what do you make when you spend the new money, not what did you make on historical returns, because they could be different. So that's why we're using return on new investment on the slide, because we're talking about the incremental IRR, not the historical IRR.
So that's like an expected IRR based on future. Okay.
Yeah. What are you going to make on this money that you're investing in? So I put in 50 million, what am I going to make on that? Now, in the simple example, I'm saying that what they made in the past, they're going to keep making in the future. But that's not always the case. And we have to differentiate. Questions, other questions about this? Does this conceptually make sense? Because let me show you how this applies. So I'm going to go back to Bloomberg for a second. And I'm going to look at NVIDIA. Okay. So what is NVIDIA's growth rate? We'll just use revenue as a proxy. 58, 30, 23%, 26%. That is NVIDIA's growth rate. Okay. Now, in finance, we make an assumption that growth in profits and growth in sales are correlated. Because if your margin's the same, then the growth in profits and growth in sales will be the same. Okay. So in order to fund this G, growth in sales, growth in profits, okay, they need to have internally 29 in 2025, they need a 30% ROI, 25 to 30% ROI. If they don't have that, they're going to have to go borrow external funds, assuming they pay out dividend. So let's look at their ROI. Assuming the past repeats itself, which it never does, but assuming the past repeats itself, right now, NVIDIA's ROI last year loading the template was 13% last year. So that's the point. First thing I would know, this is assuming they paid no dividends, right? Now, in terms of NVIDIA, do they pay dividends? The answer is DPS, dividends per share. They do pay a dividend, okay? So they pay a dividend of 16 cents on $7 of earnings. So not paying much in dividends, but that's the point. If they have a 13% ROI, they're paying out about 5% of that in dividends. They have about 12.5% of growth with internal funds right now, assuming that ROI continues. So the point is, I already know that if they're going to grow at these rates, they're going to be borrowing money. All right. Now, given what you just saw about their revenue and the returns they're probably going to get on that revenue, I don't think anybody's going to be concerned about lending them money because they see all of that future. But that's the point. They're going to need some external financing in order to fund that growth. I can see that with NVIDIA. If I go to a company like Google, as an example, Google is going to grow 10% a year. These are Google's expected growth rates for the next 4 years, 10, 12% a year. Right? Google's ROI last year, let's assume it continues. Also is Alphabet, by the way. Google's ROI is last year, let's assume it again, proxy for what it should be in the future, 21%. So if I make it 21% ROI and Google's payout is close to zero, that means they can grow at about 20% a year. Google's growing at 10% a year. What happens to all the rest of that cash?
Distributed.
They're not paying it out. They're not giving it to investors. So what happens to the cash? As Google grows from 233 billion to 330 billion in sales, which is going to grow at a rate of about 6 to 12% a year, considering they generate enough of an ROI to generate 20% growth. If they don't pay it out to investors, what happens to the difference in the cash?
They either reinvest it or that maybe goes to bonuses or other things like that.
If they don't pay it out in bonuses, which is part of the reinvestment, goes to the bank. Google's cash balance will continue to grow. You ever wonder why Google, Apple, Meta have such huge cash balances? Because that's the point. They generate very high ROIs and they invest what they need and they still have cash left over and they don't pay it all out. So they just accumulate huge amounts of cash. Google's cash balance will grow. That doesn't mean they can't choose to pay the dividend, but they really haven't paid huge dividends so far. That might start to change in the next couple of years. But that's the point. You ever wonder why these big tech companies have so much cash? This is why, right? And it's just the mechanics of growth. Now, I'm keeping it high level, but this is the technical stuff that you need to start to understand these relationships because it can be very important when we get to valuation. Second relationship I want you to understand, going back to a definitional thing, is something called free cash flow. Okay, free cash flow is critical. A company is not worth the sum of its future profits. I'll say that one again. A company is not worth the sum of the future profits. And the reason why is because they're going to have to take some of those profits and reinvest or the company's going to fall apart. Buy a car, keep it for 10 years, don't do any maintenance on the car. I'm telling you, that car is not going to last 10 years. So you keep a car long-term, you're going to have to put maintenance on the car. You're going to have to do oil changes and tune-ups and change the tires, or the car is going to fall apart. Well, the same is true with a company. If you have a profit, you're going to have to take some of that profit, and just like maintaining a car, you're going to maintain your company. Your buildings are going to crumble. Your IT systems are going to get old. You're going to have to reinvest. So you can't pay out your profits because you got to reinvest some of it. If you want to grow your business, you also got to take some of the profits and put it back in to keep growing. Somebody's got to fund all these data center investments that Amazon's making, right? If they're going to keep growing. So that's the point. I got to spend that money, take the profits to reinvest. So the point is, I can't pay out my profits because I reinvest some of the profits. So what I can pay out is the profit after the reinvestment. So there's not an accounting term for that. The accounts don't have a term called profit after reinvestment. They just have profit. So we finance people created our own term for that. Profit after reinvestment is called free cash flow. And that is a very critical number because that is the number. The key word is free because it's free and clear. That is the theoretical payout rate. Free cash flow is the theoretical payout rate for a company. I say it's theoretical because I could generate the cash and put it in the bank and not pay it out, but I could technically pay it out. So that's why it's called the theoretical payout rate. But the idea is free cash flow equals payout. And that's why it's critical to operating value. Somebody have a question or comment in the chat? What factors determine the premium price that is paid to purchase a company? I mean, the whole idea of an acquisition is 1 + 1 has to be greater than 2.3. That's your acquisition math. Which means when I buy somebody, I usually pay a 30% premium for them. So when I put the two companies together, I have to do 30% better than what they were doing before I bought them. Otherwise, I'm not going to justify the premium I typically pay. So I need more cash after I acquire them than they would have otherwise gotten standing alone. So there has to be some sort of, somebody said in the chat, future prospects, some sort of synergy, which says they get more revenue or more sales than they otherwise would have gotten, or they would have gotten cost savings that they wouldn't have had if I bought them. So for example, I'll buy you, we have 2 corporate centers. We don't need 2 corporate centers. I'll get rid of your corporate center, keep 1 corporate center, cash savings. That's something we wouldn't get if we were apart. All right. Or I have a much bigger company with a bigger brand and more access to markets. You don't have that as a small company. So by buying you and plugging you into my supply chain, into my branding, into my customer base, we're going to go sell a lot more products than you otherwise would. So that's why I'm paying a premium for you. But ultimately, it's the purchase price premiums based on generating more cash. And we can actually forecast that and model that in the way that we're going to model and value companies. Other questions or comments about any of this? Next week, you're going to start getting technical. High level free cash flow, which is the theoretical payout rate and the operating value of firms, is profit after reinvestment. Profit is cash from the income statement. It's basically no plat plus depreciation. It's called gross cash flow. Minus gross investment in the balance sheet. That is investment in working capital, investment in property, plant, and equipment, called capital expenditures, investment in acquisitions, goodwill. Those are the 3 operating balance sheet investments that you make. The difference between the cash from the income statement and the operating investments in the balance sheet, that's free cash flow. That is the key to the value of companies. You are worth the sum of your future free cash flows. So when we model and value companies, we have to model and value their free cash flows. And typically it starts by modeling their financial statements. That's the process we're doing in this class. Now, one more math slide. A lot of data in this slide, but this is actually another critical point for the semester and what we're about to talk about. I told you that there was a company A I made up. We talked about a little bit earlier. That's the data from company A, growing $100 million, 5% G, 5% a year. I'm going to throw a competitor, company B, in there. They also grow their profits at 5% a year, and they have identical profits, 100, 105, 110 million. ... continuing in the future. So you have 2 companies with identical profits and identical growth rates. And I'm going to say they have identical risks. So same whack. So same risk, same growth, same cash profits. Would these 2 companies, based on the data on the screen, have the same value, or would one of these 2 companies be more valuable?
Can I take a stab at that?
Please.
Wouldn't it be company B because they have more room to invest more in the future?
How do they have more room to invest more?
Their reinvestment rate is lower, so they have more room to increase that and grow faster.
And because they reinvest less, what does B really have?
A better payout ratio.
Why do they have a better payout ratio?
If they're investing less, if they're reinvesting less, they have, I guess, 75% to return to investors or bank.
So better payout ratio because they will have more free cash flow. Okay. So he is exactly right. And that's the point I want you to understand. So are you seeing my mouse move across the screen? You sure? So we see that company B does not invest as much as A to generate the same profits. Everybody see that? And because they have less investment, they generate more free cash flow. So more free cash flow for the same profits. Company B will be more valuable. This adds up to a bigger number than that. Okay. But here's what I want everybody to follow, and this is the important logic. Company B has more free cash flow because they don't invest as much. The reason they don't invest as much is because they have a 20% ROI. They have a 10% ROI. They're better at what they do. If I have a 20% ROI, I don't have to spend as much to generate the same profits. If I have a lower ROI, I have to spend more to generate the same profits. So to me, I'm not cutting corners. This company, which invests less to generate the same profits, will generate more cash out of those profits and be more valuable. Or, there's a big or. Let's say company B invested 50, not 25. Well, they invested the same as A. They invested 50 at a 20% return. Their profit would be 110. It wouldn't be 105. So if they invested the same as A at a 20% return, they'd have higher profits. Higher profits for the same investment equals more free cash flow. In either situation, if you have a higher ROI, you will generate more free cash flow. You will be more valuable. And that's the point. ROIC equals free cash flow. ROIC is easier to calculate than free cash flow, but they're the same thing. McKinsey's approach to valuation is they are an ROIC valuation based company, which means they're a free cash flow company. The problem is you go to a real world company, you ask them about the free cash flow, and they stare at you like my chihuahua. Nobody has any idea what you're talking about, right? Talking about return on investment, fairly intuitive. They're the same thing. It's easier to calculate, but it's the same thing. If you generate a higher ROIC, which is a proxy for your cash flow, you will generate a higher free cash flow. You will be more valuable. Caveat, at the same level of growth. If you make a 20% ROIC, you're generating 20 cents of cash per dollar. If you make a 10% ROIC, you're making 10 cents of cash per dollar. 20 cents per dollar per year is worth more than 10 cents per dollar per year. That's more value. Caveat, at the same level of growth. 20 cents that grows at 1% a year is not worth as much over time as 10 cents growing 10% a year. Do the math forever. Start with a dime and compound that growth at 10% a year. And start with 20 cents and compound that growth at 1% a year. Eventually, that 10 cents growing at 10% a year is going to surpass the 20 cents growing at 1% a year. That's valuation. Valuation is a function of two things: how much cash you generate, ROIC is the proxy, and how fast you grow that cash. That's DCF. Okay, that's key to valuation. The third element, what's your discount rate? I got to present value all of this. So three things drive valuation: cash flow, growth rate, discount rate. That in finance is called a perpetuity. So when we value a company, the difference between a company and essentially a project is projects end and companies last forever. We assume companies are going to be around long term. So I need to value the cash flow forever, for a very long period of time. Well, in finance, that's called a perpetuity, perpetual cash flow. And if that cash flow grows at the constant rate, it's called a growing perpetuity. That formula at the bottom of the screen is how we value stock prices. They're basically a growing perpetuity. Cash flow is free cash flow. Growth is the very long-term G of a company, the growth rate, sustainable growth rate, and the WACC is your discount rate. Tell me those things, I'll tell you the value of the company. Free cash flow divided by R minus G. That is how we value companies. That's what we're going to base key value drivers on the semester. Two inherent challenges with that formula. Inherent challenge number one, we are simplifying an entire company's future into 3 numbers. Deal with it. It's what we do. Okay. Second, there's an inherent challenge in this because it assumes that the internal rate of return on future cash flows equals the internal rate of return on historical cash flows. And that is a problem when we do valuation. Translation, whatever ROI you're making now, you make forever. If Google's making a 21% return now, and I value them using this equation, they're going to make a 21% return forever. They will never falter, they will never mature, and I will overvalue Google. If I use this to value an automobile company, which had a rough 2022, and they're making a 5% ROI, they will never improve using this growing perpetuity in the future. And I will likely undervalue them because they will have no upside in their future when I use this formula. That is the formula you were taught to use. And that is the limitation of the formula that we use in finance. Somebody just raised their hand. It was Peter.
A curiosity, which may be better answering at the end of class, but since we're valuing these and projecting 3, 4, 5 years into the future, do you know how often these predictions come to fruition and what the, I guess, the standard deviation of those guesses are?
There's 2 answers to the question. The one answer is the analysts, the people that are and the buy and the sell siders that are making these projections are constantly adjusting them. So when you say come to fruition, like when new information comes out about NVIDIA and I realize that they are the AI chip of the data center and data centers are gobbling up, and I didn't realize that, then suddenly all those projections for the out years of cash flow just went up dramatically, which is why NVIDIA's value went up so much in the last 12 months, because that was relatively new information, even to the sophisticated analysts. I know people understood that NVIDIA was the technology that was powering AI, right? And that their chips were the ones that ChatGPT and all these other companies were going to start using to run their AI platforms. That was newer information, and the market has adjusted. So you go back a year on NVIDIA, their share price targets were far different than what they were today, but the market has adjusted. So you could say, yeah, they were wrong, but they were all wrong because they lacked information. And now with better information, that they tend to be more right. So it's kind of like a little bit of a chicken and an egg to your question, but over time with big data sets, which Chicago showed go like decades, that the market eventually gets it right. Like whatever cash you do generate will become your price. So that's what will happen with the long-term trend. But in the short term, we're still playing that guessing game. And it's easier to guess some companies than others. Because like I said, Verizon, very predictable company. Costco, very predictable company. Costco's probably not going to double in size outside of a merger in the next 5 years, right? But they're also not going to fall off a truck, right? So they're a very stable, predictable business, growing 2 to 3% a year with pretty constant margins. They're actually pretty easy to model out the cash flows. NVIDIA had a big change in their business. That made them a little more challenging to model out the cash flows. But the market's going to figure that out. And that's what they're trying to do right now. Does that make sense?
Yes. Thank you.
Question?
Yeah, good question. So in terms of the return on investment, you're saying like we're looking at like let's say for example 20%, and then we keep that as constant. But if you know that a certain division, for example, NVIDIA, we know that the data center division is going to grow. So can we look? Do we have information typically like on Bloomberg whether how much more or return on investment in that area is, because that's what is going to be the future growth for the company?
That's the point. We would forecast that. We
forecast. Okay.
Forecast. What do we think we're spending on data centers? What are we going to make when they actually sell the data center chips? Margin. And that margin may be different than the past, because what they're making on their data center margins right now, if they're the only game in town, I bet it's a pretty high margin. But I would also bet that in a few years, they're not going to be the only one selling in chips to data centers. I'm sure Intel and every other semiconductor company is trying to tout their engineering chip technology as working with AI, and other competitors are going to start coming in there. I mean, even Apple, Apple's arguing their A whatever chip, on the phone can do AI processing. So other people are going to kind of go after NVIDIA, but right now NVIDIA overnight has like woke up to become the dominant player in the marketplace. But that's the point. Doesn't last forever. We got to try and model how that's going to play out over time. Might be a long runway, might be a shorter runway. That's what people got to figure out, right? But the process is relatively straightforward, right? But here's the point I want to make about the process. This is what McKinsey did. That's in your book. That's different than every other textbook. This is the growing perpetuity equation on the left. This is what McKinsey calls key value drivers on the right. It's just a rearranged growing perpetuity. So McKinsey tried to improve on this formula for the reason that I just told you. Problem with the growing perpetuity is it assumes the IRR on future cash flows equals the IRR on historical cash flows. If the future looks different than the present, the formula breaks down. So here's how McKinsey tried to improve upon it. Cash flow is free cash flow, profit after reinvestment. Sustainable growth is the investment rate times the ROIC. Therefore, investment rate is growth over ROIC. They just rearranged the equation. But by rearranging the equation, this is a growing perpetuity. Instead of free cash flow, they break out profit and ROIC. This ROIC is incremental ROIC. This is return on new investment. So in the McKinsey version of the growing perpetuity, you can forecast an ROIC that's incremental. In the traditional growing perpetuity, you can't. It just assumes whatever your IRR is, it stays the same. Now I have one IRR, one ROIC incremental for the entire future of the business. So I got to get it right, but at least I can actually make it different than the past. And this is why the McKinsey version is an improvement over the traditional textbook version. But this is what we will use this semester, and this is what we'll use to better understand share prices. Okay. Now, we're about to do an exercise to help you put a couple things together. But before we do, I want to show you some math. So I'm going to share my desktop. And just because it'll be easier to jump around. But here's what I'm going to do. If you see this formula right here, that's the formula to value things. It's got 4 parts to it. Expected profit, because I care about your future profit, not your historical profit. Your expected growth rate, your expected ROIC in the future, and your cost of capital. Those are the WACC. Those are the 4 parts of the formula using friendly terms. Okay. Now, on the slide deck that I showed you earlier, I gave you these 2 hypothetical companies and I asked which one was more valuable. And intuitively, I think, was it Patrick said company B was more valuable. We went through the logic why B was worth more than A. I want to do the math. So using the data that's on this slide, I want to do the math for A and B. So here's the data. Both companies started out with 100 million in profit. Both companies' G's were 5% long-term. Company A had a 10% ROIC. Company B had a 20% ROIC. And both companies had WACCs, cost of capital, hurdle rates, 10% each. The value, the result of this equation says equals profit times 1 minus the growth divided by the ROIC. Take all of that divided by the cost of capital minus the growth rate. Company A would be worth $1 billion. Company B would be worth $1.5 billion. So what the math tells me is I'm just quantifying what we intuitively said earlier, that B would be worth more than A, B would be worth 50% more than A. They'd be worth $1.5 billion. Company A would be worth $1 billion. Based on these numbers, if they continued out in the future. That's the cash flow values of each of the firm, present valued. There is something called a price to earnings multiple. What is the price to earnings multiple of company A? What PE would they trade at? I heard, is it Ed Tutu? You said something, but you're on mute. I saw you both.
Oh, I said 10.
That's your 10. Because what their price is $1 billion. Their earnings are 100 million. They would trade at a PE of 10. You're exactly right. Their PE, 1,500 divided by price, divided by earnings, they traded a PE of 15. That's the other point. Multiples, comparables, whatever you want to call them, are just rearranged math. They have to give you the same answer, law of one price. Just because you changed your approach doesn't change the value of the company, same value of the company. And that's the point. What you're going to realize is all of these DCF, multiples, however you want to value companies, it's just the rearranged cash flow math. Cash is cash. One amount of cash, it's always going to be worth the same. But that's the point. Key value drivers. Why am I paying more for company B than company A?
Because their ROIC is higher.
That's the only difference, right? Because that's the point. They have a higher ROIC than A, and so therefore they generate more cash than A and more value than A and have a higher multiple than A. What are the key value drivers? Growth, return, risk. Growth, spread. Right here. That's the key. Key, any value of any company. Right? So before we do the exercise, I want to do NVIDIA. Will this work out for NVIDIA? Okay. Now, I'm going to cheat. Okay. And I'm going to do their actual price to earnings multiple. And what I mean by cheating is that when you do an actual price to earnings multiple, price is based on earnings per share, which means it's based on net income. Okay. It's not based on NOPLAT, it's based on net income. Okay. So you can use the exact same formula. It's key value driver formula. Uses exact same formula. Profit is net income, growth in net income. This becomes return on equity, and this becomes cost of equity. And you can follow the exact same formula with just equity values to get a share price. So I'm going to see if that works for NVIDIA. Okay, so let's look at NVIDIA. What is their expected profit in the real world today? And I hope this works because I didn't do this before class. We're going to find out in real time whether or not this works. NVIDIA. All right. NVIDIA's expected profit next year in 2025, fiscal 25, their expected profit, net income, is $25,429 million. You might say, why is he using 2025? Two answers. Answer number one, forward multiples are more predictive of a company's value than historical multiples. You're worth the sum of your future cash flows. You're not worth the sum of your historical cash flows. So therefore, I care more about your future earnings than the historical earnings. So what's going to drive NVIDIA's value is not what they made in 2023, is what they're expected to make in 2025. Right? So $25,429 million. What is their, this is net income. This is growth in net income. This is return on equity. And this is cost of equity. All right, so what is their return on equity? Expected to be 55%, 48%, 42%, 39%. I'm going to say 40, somewhere in that range. Just ballpark it. These are the analyst guesses for the next 4 years, long term, about 40% a year. Okay, taking a swag. 40% return on equity. What is their cost of equity? Well, if I do their WACC today, their cost of debt is 4.5%. Their cost of equity is 14.5%. They're almost all equity, so their WACC is 14.3. They're 98% equity, 2% debt. Right? So that's today. So 14.5% cost of equity using CAPM. This is CAPM. Okay. Here's today's risk-free rate. Their beta is 1.68, 6.33% cap market risk premium, RM minus RF. That's a 10.6% equity risk premium, plus the 3.85 10-year treasury rate, 14.48. Okay, so that's just CAPM in the real world today. Bloomberg does it for me, 14.2. So here's the point. With no growth, the value of NVIDIA would be $179 billion. And oh, by the way, their PE would be 7. Well, clearly, they're going to have some growth. Their PE is not going to be 7. So in the real world today, their actual PE this is the model PE. Their actual PE is price at 2025, 25 billion of net income becomes $10.51 a share. 439 divided by 1051 is a PE of 42. 41.78 is their forward PE. Close the market today. So what growth rate is the market expecting? I'm going to use goal seek. So goal seek, I'm going to set this cell to 41.78, which is their actual PE in the real world today, by trying to estimate their long-term G. And the answer is a little under 13% a year. That's NVIDIA today. NVIDIA is a company that makes a 40% return on equity, grows their equity at about 13% a year, discounts it at a high rate of 14%, and that gets you a 42 PE. And by the way, that gets you a market cap of $1.062 trillion. That's $1 trillion market cap. Now, am I even remotely in the ballpark for NVIDIA? Today, at their closing share price, their market cap is $1.084 trillion. And our swag of a formula said $1.062 trillion. I shouldn't be that far off, because these are the formulas that have to be used to value the company. Yes. Patrick?
Yeah, I might have set the formula up wrong, but can I ask, if you continue to increase the growth, the expected growth rate to like 20%, it breaks? Is there a reason it would break? Is that like
It's a matter of reason. In a perpetuity, your G cannot be higher than your R or your WACC in perpetuity. Because conceptually, what it would mean is you would literally in the world. If your G was higher than the hurdle rate, because then there wouldn't, you do exceed the opportunity cost to the point that no one would choose anything else. So just conceptually, the math breaks down. So G can never be higher in perpetuity than your WACC. That's why. You could approach it, but you can't get higher than 14.2. That's why. And for those of you that want a copy of what I just did, I'm happy to share this and post it on Elms. But again, this is jumping a few classes ahead. This is what you're doing in week 4 when I talked about multiples. Like the book walks through this methodology, you'll be doing homework assignments that will build you here. I'm just giving you a conceptual overview of what's kind of coming. But I also wanted to link it back to say, look, I am not teaching you things that are not practical in the real world. This is what we do. And these things work because that's the point. Like if I know what your cash flows are, I can price you. Now, multiples, the major difference is I basically just simplify to say today represents the entire future. So the entire future is this one formula. What you do at a DCF is you say, well, I don't want to use a blunt instrument. I can actually forecast NVIDIA that could be fairly accurate. So rather than using this formula for all of NVIDIA, what I'm going to do is I'm going to have a defined period where I forecast NVIDIA for 5 to 10 years. And then as my forecast becomes less meaningful, I use this to proxy the long term. That's called a continuing value period. So typically in a DCF, you forecast a defined period until it becomes harder to forecast. Then you do this and you put the two together in present value. Okay, that's DCF, right? But if you wanted to be simplistic, you can actually use this for a publicly traded company, for even not a publicly traded company, to basically just do forever. And that's just what I like to call the broadsword, not the scalpel. But you can do it. It just, your entire forecast is these 4 numbers. So that's a little less granular. And so that's the multiple approach. Multiple is the shortcut. So here's the 2 key themes you should understand. ROIC is a proxy for free cash flow, which drives value. Multiples are the shortcut or proxy for cash flow valuation. You want to do it right, you do a DCF. You want to do it short, you do a multiple. Okay. You want to do it right, you do free cash flow. You want to do a shortcut, you do ROIC. Okay. Conceptually, they're the same, but that's the point. I don't want to read the book, I read the Cliff Notes, ROIC. Okay. But conceptually, these are the drivers of value for a company. Questions, comments, concerns, crippling fears? All right, I've been talking too long. So here's the deal. I'm gonna give you a chance to work as a team. And in this case, I'm gonna do made up teams because I'm gonna do them in Zoom for this week. I'll give you a chance to apply and practice here what we have been talking about and make sure that you understand how as these things change, it changes value and it will come up with a few scenarios, which are kind of the 80-20 of the theory. Meaning if you understand the scenarios, the exercise that I'm about to give you, then that's 80% of what you really need to understand about how valuations will change when metrics change. Right? So in order to do so, I'm going to put into Elms 2 files. It's going to be in the file section. And I'm going to put it into a folder called week 1. And in this folder called week 1, I am going to put 2 files. One is a file called key value driver exercise, and the other is called key value driver exercise.xlsx. those are the two files that I am uploading to trying to upload to this folder. Both files are there. So what I need you to do is to download the two files. I'm going to put you in Zoom rooms in a second. I'm going to ask you to have one person share your screen and go through the scenarios in these files. And so just take it back to Zoom. Here's what you're going to do. Don't mind the Duke branding. I'm an innovation fellow at Duke. This is my case. So basically, what you're going to do is you're going to have the spreadsheet open, which has that key value driver formula, company AB example that we just talked about. And then you're going to start with making these changes, see what happens, and answer these questions. Okay. So there's a little simulation. And there's 6 scenarios on these 2 pages. And then we will debrief what these 2 questions are helping us answer. Right. I'm going to include a 5-minute break and give you 15 minutes to work on this in Teams. So we're going to talk again about this in 20 minutes at 9:20. Okay. So I'm just going to put you into random teams and ask you to work on this. And then we'll debrief this again at 9:20. Okay. So you're going to be in Zoom rooms that will close back in 20 minutes. I'll let you choose. Put you in 5 teams. I'll let you choose whether you want to take a break and work on it or work on it and then take a break, but finish it up in about 15 5-minute break. And then have, like I said, one person share the results and then be ready to talk about this at 10:20. All right, welcome back. Recording is back on. So how about room 1? Why don't you start talking to me about the first scenario or 2? And you feel free to share your Excel file or to walk me through what you did and learned. Kathy, Arun, Slitus.
Oh, that's us. Sorry, I didn't know what number we were. So for the first couple where we're changing the values in A, what we noticed right away is as long as ROIC and WACC are the same, the growth rate has absolutely no or reasonably no effect on the multiple.
Okay.
Which makes sense because they're not generating any return for their investors, no matter what the growth rate is, even if it's negative, it just doesn't have an impact.
Versus
if it changes, like if there's any difference at all, suddenly
in the second part of that, when B started to grow. So why is the value in multiple changing on B and not A?
because their ROIC is greater than their WACC or different from their WACC.
Okay.
Because any difference up or down does allow it to have an impact.
So those are 2 very important things I want everybody to understand. So the first is, I like to call it the treadmill. Basically, a company generates a break-even spread and they grow and they're like, why isn't my growth being valued? And the answer is kind of like a treadmill. You're not really creating any value. You're just kind of running in place. You eventually get tired, right? Because you borrow a 10, you invest, you make 10 pays off the 10. There's nothing left to give back from a value standpoint. Versus growing a positive spread, like that becomes exponential. Like if I can borrow a 10 and make 20, I want to do that all day long. So ultimately, that's where investors get the high value companies. It's the company Bs, not the company As. And so there is good growth and there's bad growth. And you can start to see the difference here in these two scenarios. Does that make sense to everybody? Now, before they did these two scenarios, they actually skipped the very, very first part. What happened? Room 2.
Oh.
Jump to room 2. What happened when you first changed the profits? What happened to the values and what happened to the multiples when you changed the profits? It's the first.
Okay, for room 2, when we changed the profit, that's question 1 to 200, and with question 2 to 300.
Yep.
For company A, the value increased at the same percentage as the same growth rate as the profit. It increased by the same percentage as the profit is increasing. And then for company B, when we change the profit, sorry, we didn't change profit for company B. Well, if I change company profit for company B here to 200, I can share my screen.
Follow along.
Okay, this is for company A. When we changed it from 200 to 300,
Yeah.
the value increased from 8 billion to 2 billion and 3 billion respectively. And if I change for company B to 200 and 300 as well, the value also increases.
But
so
what didn't change?
What didn't change is the multiple.
So why?
Because the main drivers of the multiple is the value and the profit. And if they're increasing at the same rate, then the multiple is not going to change.
Okay. Let me reframe this. So this is what I like to call sizing in finance. So one way that you can become more valuable is you're bigger. You just generate more cash, right? That's going to change your value. But you're not better. You didn't change your business model. Okay, so the long-term multiple, the business model doesn't change, which means what's driving the multiple is the growth rate, the return, and the WACC, right? What's not driving the multiple is the absolute amount of profit that you make. But that just says there's two ways you can drive value. One, just become bigger, just do more bigger NPV positive projects. But number two is do more valuable projects, do ones with higher ROIs. Both can lead to higher values. And that's the first and second point that I wanted people to understand. Everybody see that? So change the cash flows, change the profit, multiple doesn't change. You can make that expected profit $1 and it won't change the multiple. So go ahead and do that. Change cell G3 to 1. Or just put a 1. Notice the multiple doesn't change. So as I said, you're smaller, so you're not as valuable, but you're still doing really well on that $1. Key value drivers, row 4, 5, and 6. That drives multiples. Okay. So thank you. All right, room 3. Avery, Caitlin, David, Rachel, William. Talk to me about the next scenario. So the last two teams got through the growth at no spread, growth at a positive spread. What happens when you have the high spread, but the growth rate started to shrink? What happened in that situation?
So when you're talking about, so the situation we're talking about is when we had company B with its initial spread, and we reduced it down to 3% growth, right?
Yeah, what happened in that? What was going on there?
I can share real quick.
I got it, William.
Okay, thanks.
Yeah.
So what we saw there with the 3% is that the value actually fell in comparison to its initial 5%. So there was a point at which that reduction in growth rate began to pull down the value multiple from its original value.
Okay, but why is the multiple declining?
I think it's reflective of the closing gap between the return on investment and the cost of capital.
So let me help you out here. So what's happening is, this is the expectation cornerstone, by the way. I price you as if you make 20 cents, 20%, and you grow it 5 or 8% a year. I realize that was too optimistic. You're going to make 20 cents, but you're not going to grow 5% a year. You're going to grow at 3% a year. Well, 20 cents growing at 3% a year is worth less than 20 cents growing at 5% a year. Your multiple will come down. Your value will come down. That's what's happening. Okay, because when your growth slows, the rate of change of the cash that's growing goes down. And when that rate of change compounded over time goes down, the multiple is going to contract. The multiple is going to be worth less because your value is going to start to go down. Right. And that happens to companies all the time. Two things will happen. Either one, I'm over optimistic and they'll miss their earnings. So the company didn't make as much as I thought. Well, if they don't make as much as they thought, they're not going to generate as much cash. They're not going to grow the profits as much. Therefore, they're going to be worth less. Or a company matures. As companies get bigger, they get more mature. Right? If nothing else, there's a law of large number effect. So as the company gets more mature and its growth rate starts to slow, the multiple is not going to be as high. It doesn't mean it's a bad company. It just means it's a different setting for its type of valuation. So we have three scenarios. We have growth at no spread, the treadmill. We have growth at high spread. That's the one you really want to find. You have kind of the mature cash cow, which is the slowing growth, but still high spread. Team 4, Carlos, Isaban, Mike, Stephen, Thomas, Stephen, Thomas, give me the next scenario. What happens when the ROIC goes below the WACC? What happened in that scenario?
Isabon, can you share?
And I'm trying to, everyone else had it so nice and neat. Let's see here. What questions are those?
I think it was both the multiple and the value of the company drops.
Okay, why?
Because you're spending more money at a rate that is faster than you're returning the money.
Okay.
So you're sort of like, it's why after that you drop the growth rate lower, it jumps back up because you're becoming more efficient or you're just spending less. And it's hard to articulate what is actually happening.
You're throwing less good money after bad.
Yes, that's a better way to say it.
Basically, it's like, hey, I'm digging a hole. Well, stop digging.
Yeah.
Fill the hole a little bit. Stop doing the bad stuff. And ideally, if you're borrowing at 8 and you're making 6, do less of that, and you'll become more valuable. That's the poor scenario. So that's the point. When you get into this situation, when you have this really low multiple company with low spreads that are negative, like, you want to disinvest. Those are the companies that should be looking to, sell off, shut down, take capital away from those businesses, because they're not really creating any value. They're actually destroying them. That was that poor scenario. That's what they have in column D right now on the screen. All right. So wrap me up, team 5. Chris, Gina, Isaiah, John, Joseph. What happens when the cost of capitals change? That was the final end of the exercise. What happens in that sixth scenario when the cost of capitals change? What happens to the values?
We didn't get to that piece, but I'm looking at it right now.
Pull it up and let's do it in real time.
Isaiah, can you pull up your spreadsheet?
Yes, give me 1 second here. There we go. Okay, cool.
The long-term growth was supposed to be 5 for both companies.
I want you to do me a favor. Put 5 and 5, and then in B4, put 10. Okay, and then basically repeat that down there with 13 through 16. So put 5 in B14. And then 10, 20. Okay, so now they're identical, right? Now here's what I want you to do. I want you to raise the ROIC to 12 and the other one to 22. And I want you to raise the WACs to 12. So company A still has a 0 spread. Company B still has a 10-point spread. What's the difference in the values between the top company A and B and the bottom company A and the B? Why are they different? Why are the values lower at the top of the screen versus the bottom of the screen? Why are the multiples lower at the top of the screen than the bottom of the screen?
Giving away 2% in terms of cost of borrowing.
So how does that play out? Why is that leading to a lower multiple?
The risk,
Or the overall value decreases, right? So you're not, because the value that you're generating, you have to give to the cost of borrowing. So overall value will be lower.
True. But why is what's happening in the math?
Is it because it's decreasing the free cash flows?
It's not that
At a
it's
greater.
free cash flows. The free cash flows we didn't change that. Matter of fact, the free cash flows for the top half of the screen are actually higher. 12 and 22 is higher than 10 and 20.
Your denominator increases, right? Is that what you're asking?
No, what I'm talking about here is the concept of discounting. See, the thing is we're discounting these cash flows.
Right.
And we're discounting the cash flows at a higher rate in the top half of the screen. And that we're discounting the cash flows at a lower rate in the bottom half of the screen. So what I want you to understand is WACC/hurdle rate, cost of capital, affects valuations, right? Because even if you have the same spread, if you have a higher hurdle rate with the same spread, 0 spread for company B in both in column B for company A in both situations, 0 spread. Because of the higher hurdle rate on the top half of the screen, 12% versus 10%, even though the 0 spread's the same, they're going to be worth less because you're discounting the cash flows at 12% in the top half of the screen. You're discounting the cash flows at 10% in the bottom half of the screen. So there is another factor at work in company values, which is risk. Because risk adjusts the hurdle rate, and hurdle rate is discounting the cash flows at a different amount. And that's something that is overlooked by a lot of people. Like when they value companies, they forget that the hurdle rate is also at work. And so if I have a company that has a lower hurdle rate, they don't have to have as high a rate of return to have the same value because I'm discounting those cash flows at a lower rate. And so there's 3 factors that drive value: growth, return, risk. And those are the 6 scenarios. And so that's the point. If you kind of understand these 6 scenarios conceptually, you have a pretty good idea of what's going to happen to a company's share price. Are they generating more cash flow? Out and out. Okay, that should raise the share price. Are they facing a different risk level? Higher hurdle rates? Guess what? Interest rates go up, stock prices go down. It should be no surprise to you that the stock market was rather choppy in the second half of 2022 when the Fed took interest rates from 3% to almost 6%, right? Because companies are faced with with much higher hurdle rates because interest rates went up and their cash flows didn't change, they didn't double, then basically those cash flows are worth less. And stock prices were under a lot of pressure. Right? What's been happening recently? People are like, oh, now that inflation's starting to come down, maybe interest rates are going to start to go down. So basically what they're expecting is lower interest rates long term, which are higher stock prices. That's why the stock market's actually been going up recently. There's an expectation that interest rates are going to come down, and therefore cost of capitals are going to start to come down again. Market's wrong. You don't want to own stocks because higher hurdle rates equal lower values. That's what's playing out here. This is just math, but it's important to understand the key value drivers. Saw somebody had a hand there a second ago.
Yeah, that was me. And I guess the question with all this is, how often do companies, in terms of knowing they're being valued, like manipulate these levers to put out better numbers when it potentially doesn't quite reflect the exact situation that it's going on in the company? Like Google sitting on that massive amount of cash can probably do a lot to affect these numbers and whatnot.
You use the word manipulate. That's the whole point. Like if we're tracking the cash, it's harder to manipulate the cash unless you're like doing really bad things. And so it has less to do about the cash than the expectations. Like figuring out realistic expectations is really critical. Now, in the short term, you can kind of talk up some expectations and you might be able to fool the market. But when you don't meet those expectations very quickly and you don't have credibility, then they'll adjust, and they'll adjust very painfully if they think that you're actually telling them things that aren't true. So that's the point. Like the market could get it wrong, but it's not going to be wrong for too long because you're constantly reporting results. And so it just gets back to, it's an expectation game, and you're going to be wrong with the expectations, but companies shouldn't try and manipulate the expectations. That's the worst thing you can do. One, it's fraud, but two, like the market's going to painfully, when they realize that you're telling them things that aren't necessarily true, they're going to painfully sell you. And
So to follow up with that, then when someone like an analyst is valuing a company, they don't necessarily need to worry about like inside trader knowledge. They have a decent ability just to look at.
Well, they do. I mean, ideally, you want to know from the insiders because they have a better understanding than the outsiders what's likely to go in the business. But that's the point. Like there's something called Reg FD, which says that an insider has to get the same information to the outsiders at the same time. You can't advantage somebody with that. That's insider trading. And that is technically illegal, right? So you're not supposed to do that, right? But what I'm also saying is information is pretty, available outside the firms because, matter of fact, some firms I work with actually have the analyst forecasts that help guide them on what's going on because the analysts are just talking to your firm, they're talking to all the competitors and they're doing industry research. So they actually might have a better understanding of what's going on in your industry than some of the companies themselves in terms of what they're focused on. So, it's not saying anybody's perfect, but just taking it aside, this is the core to the process. Tell me what the cash flows are, and I'll tell you your value. And this is the process by which we value the cash flows. And so if we understand how the cash flows change, we'll start to understand how the values will change. Okay. That's what I really want the message to come across for tonight. Make sense? Other questions?
I guess one more follow-up to that to conclude is when valuing someone, you can't really hide their value. Like if Joe Schmo regular were to go try to value Google or Novak or whatever, there would no, like he could just use any public information.
Yeah, we're using public information. There's nothing that I have shown you tonight that is not public.
Okay.
But that's the problem, is that Joe Schmo is likely not to have access to what the professionals with the big money and the more sophisticated tools are seeing. Like the average person, like I said, that's using Google Finance or Yahoo Finance is not going to see what I showed you about NVIDIA for the next 4 years. Even the Wall Street Journal articles, which are talking about, how great AI is going to be, they're not giving concrete forecasts. And so that's actually why, having access to a more realistic view of Wall Street's expectations is actually more important. Because otherwise you're shooting blind. Because I can say, oh, let's buy NVIDIA because I think they're doing really well. Well, what I actually showed you tonight is that the market knows they're doing well. And they're priced as if they're doing well. So there's not a lot of upside and they're doing well because all that upside has just shown up in their share price in the last 3 months. So if you get in there now, you missed the window because the market figured out a few months ago of this upside. And that's what drove their stock price way up. So not saying it can't go higher, but if it's going to go higher, those cash flows have to be even better than what I just showed you. And that's the part that the average Joe Schmo is not going to see or understand. Because they're going to be looking at 23 billion of revenue in 2022, growing at 5%. They're like, how did NVIDIA's stock price double in the last 3 months? I don't understand that based on those historical numbers when I'm looking at that historical financial statement. Like that's the problem with historical financials. Because the future just looks far different than the past. Now, it's not saying the analysts are right. That could still change. But that's their best guess as of today. Maz?
So I guess the question will be, if the average investor does not have access to that information is there a way he can generate that information based on publicly available data?
You can buy it, just cost money.
Okay. Right. No, what I'm saying, like, based on Yahoo Finance and other available online resources.
Well, I mean, I would just say, you guys have access to it. Go see. Go look up NVIDIA this week. See what you can find on Yahoo Finance and see if some of the things that we're talking about, you can see there. And you're going to see big gaps.
Okay.
Problem is information availability is expensive, unfortunately. Because that's the point. That's why Wall Street spends the money, is that you want access to their knowledge, they pay for it.
I guess a follow-up question, how do they gather that data? Like, are they just asking the companies to give them the data, or like, how do they?
Many different ways, but I'm just saying, industry research, independent, they're buying research from specialists.
Okay.
But don't underestimate the fact that I told you, you saw that coverage universe for NVIDIA. That coverage universe, they're covering a lot of different companies. So they're talking to all those companies at the very senior level. And so they're learning just by talking to all those companies, and they could triangulate. So just for example, NVIDIA is doing something with Amazon. They're going to call and tell. They're going to say, hey, we heard NVIDIA is doing this. What are you doing? Are you doing anything with Amazon? Do you use Microsoft? Then they're going to call Microsoft, their other team. They say, hey, Microsoft, what are you going to buy? And then they kind of triangulate that data amongst themselves. And that's what can make them valuable, because they can be a clearinghouse for publicly available information, because that's what they're sucking up. And if they can get an advantage with that, you're going to pay for it to get access to it, because that's how they make their money. But regardless, here's the final thing I want to do, because we got 14 minutes left. You probably thought, oh, this is going to be a cream puff first day. So here we go, back to Bloomberg. Where's my slides? PowerPoint. All right, in the interest of time, EIC. Okay, EIC stands for Economy, Industry, Company. It's a framework to understand the external environment of a company. If half your performance is that external market, what's going on in that external market? Okay, in the interest of time, I'm going to keep it simple. Economy. How tied is my industry and my company to changes in the economy? So if the economy gets better or worse, does that matter? Okay, so in your homework, which I've switched from Nike to NVIDIA, that's going to be one of the questions you're going to address in this next homework assignment. Is NVIDIA sensitive to changes in economic situations? So if the economy goes into recession, is that bad for NVIDIA, or does it not matter at all? Okay, so that's one of the questions. Industry. Okay, industry is Porter 5 forces. Basically, if a company has a positive spread, or sorry, industry has a positive spread, why does it have a positive spread? We got to be able to explain that. Okay, so we use the 5 forces model to explain that. And what matters is not today, but what also matters is tomorrow. Meaning, will those forces change over the next 5 years? And if those forces change over the next 5 years, does that mean the spread's going to change over the next 5 years? Because the 5 forces today and the 5 forces in 5 years are the same, spread's going to be about the same. If the 5 forces get more favorable, spread should improve. If the 5 forces get less favorable, spread should compress. Third, C, company. Does a company have a competitive advantage today? And what's going to happen to its ability to have competitive over time? So if it has a competitive advantage, is it going to lose it or is it going to maintain it? So if it maintains it, its relative spread to the industry should be about the same. If it loses it, its relative spread to the industry should go towards the industry. If it increases it, the spread could actually increase over time. So what happens to a company's competitive advantage over time, and what is it today? So that's, in a nutshell, what EIC is trying to answer. Okay, so we are going to very specifically start with E, and in the interest of time, I'm going to tell you what I want you to do. Okay, relatively straightforward for E for this week's assignment. So there is a screenshot in your assignment. I'm not going to use NVIDIA. I'm going to pick another company. So let's pick an airline. I'm going to go with Delta Airlines. Okay, so here's the idea. I've given you a screenshot of Delta's peers / NVIDIA's peers at your actual assignment that looks like this. And on this screenshot is the beta for each of the companies, the raw and the adjusted, and the industry average beta. Okay, and here's the idea. A beta of 1, which you should know for your previous finance classes, basically means that that company is going up or down at the same rate as the market. A beta of 1 means if the market goes up 1%, company goes up 1%. If the market goes down 1%, company goes down 1%. If you're going up and down exactly with the market over time, then you have the same economic sensitivity as the market. If your beta is 1.36, that means that the market goes up 1%, the industry goes up 1.36%. If the market goes down 1%, the industry goes down 1.36%. You're going up 36% faster than the market. You're going down 36% faster than the market. You are more volatile. Proxy, you are more sensitive to the economy. Airlines are sensitive to the economy. Air prices go up, people don't travel as much. Or sorry, economy gets worse, people don't travel as much. Okay, so that's the point. Economy booms, people travel more. Higher beta than more cyclical business, more sensitive to economic changes. When it comes to the airlines, I'm very concerned what happens with the economy. Right? If I go to discount retail, Costco. Discount retail, their beta's 0.81. Discount retail firms don't go up as much when the market goes up. The share prices don't go down as much when the market's down. They're more stable. Costco being a slight exception, Costco, the group is a 0.81. Costco's exactly at the market, but company like a Dollar General, they don't boom as much, they don't bust as much, their beta's 0.65. So that's the first point I just want you to understand for next week's assignment. Is NVIDIA economically sensitive? Yes or no? Is the semiconductor industry economically sensitive? Yes or no? Look at your beta as a proxy and answer that question. That's your first question in your homework assignment you're going to write up for next week. Second question you're going to ask in your write-up for next week is, if I'm doing discount retail, which you're going to do NVIDIA, I'm giving you the spread template that we went through earlier today. And in this spread template that we went through earlier today, which showed ROIC last year for the industry and each of the companies against the WACC. Yep. The first question is this an attractive industry? Yes or no? What is the ROIC versus the WACC last year? If the ROIC is greater than the WACC, that is an attractive industry. In this case, ROIC is 12.6 for this group of companies. WACC is 8.67. This is an attractive value creating industry. Using the Porter 5 forces, explain why. All right. Buyer power, supplier power, barriers to entry and exit, substitutes, rivalry. Why is this better or worse? Why is this a positive spread? Explain. That's the I. Using the spread, explain it with 5 forces. Then forecast what the 5 forces are going to be in 5 years for each of the forces. Write it up and then tell me what that means to the industry spread. Are the forces getting better or worse? Should the spread get better or worse in 5 years? As the second part of your homework assignment for next week. Third part of your homework assignment. Does Costco have competitive advantage? Yes or no? Using the definition from earlier in the class, does Costco have competitive advantage? Yes or no? Given this data.
Yes.
Because they have a higher relative spread than the industry. 18.85 minus 9.98 is higher than 12.63 minus 8.67. Why? Why does Costco have competitive advantage? Explain. Give me some rationale for that. And is Costco still going to have this level of competitive advantage? Are they still going to have this relative spread in 5 years? That's the third part of the question I want you to answer. The only difference is you're going to be doing this for NVIDIA. EIC. So in your ELMS, well, you guys were in your assignment. I put up the data there. Nope. So in your assignments for week 2, you have 2 assignments. Assignment number 1, EIC. Is NVIDIA sensitive to changes in the economy? Why or why not? Write it up, use some numbers. Here's some screenshots. Number 2, is NVIDIA in an attractive industry? Again, is that an attractive industry? And using 5 forces, explain, talking about all 5 forces, whether it's an attractive industry or not. Tie the 5 forces to the spread. Then what's going to happen in 5 years? Will those forces change in 5 years? And what should that mean to the spread in 5 years? On a relative basis, does NVIDIA have competitive advantage? Why or why not? Today, will that change in 5 years? Forecast. Write that up. That's the EIC assignment for next week. To help you tie this to what's going on in the real world, I gave you a JP Morgan analyst report talking about NVIDIA. I gave you an industry report talking about semiconductors. And if you go to VBIC, you can get an industry report under IBIS world, which actually has a 5 forces talking about semiconductors. So that's your data sources. Since we're dealing with real world companies and real NVIDIA information, it's perfectly okay to source real world reports. Just don't plagiarize. Okay. So either footnote or reference if you copy from a report. So don't plagiarize. It's okay to do it, but you can reference, but make sure that you put in a reference if you use something. But that's what your first assignment is for next week. Questions? It was starting to bleed. Too much medicine. Questions? Any of this? Back to the beginning. Is this an assignment for individual or group? It's up to you. You can do it individually, or you can choose a learning partner and you can do it together. That's true for any of the assignments. So if you want to choose a learning partner, put both your names in the paper and then submit it. Submitting it jointly. You both have to submit it, but put both your names on it. Assignment number 2. We're not going to have time to talk about tonight. Right here. Patrick, go ahead.
Yeah, just on the last assignment, is there a length expectation, or just really as long as it takes to answer the
If,
questions?
if you were undergrads, I'd put a minimum word count, but you're not. So
Okay.
I would just say, answer the question. Like I wouldn't just write a few bullets and submit a Word document. That's not gonna work well, but just enough to write the question, probably a page or so. But do answer the question and use numbers in your answers. So refer to actual data that's on the slides I gave you. All right, final point, economic statement conversions. It's part of one of the chapters you're reading in the book. Basically, what we're gonna do is we're gonna put accounting statements into an economic format that's tied to Modigliani mode. That video, that YouTube video, there's a link to that video, explains how to do it. It's a 1-hour video that walks through the process. That Excel file starts out with some very simple accounting statements that you will convert into economic statements after watching the video. So that is your other assignment. There's no write-up with this one. It's just taking accounting statements and putting them into an economic format. That will be necessary to do the historical analysis and to do the valuations. Okay, so again, it's an hour-long video. Watch the video, take you about an hour, hour and a half to actually do the conversion. So those are your 2 assignments for next week. Questions about any of that? All right, if you do have any questions, feel free to reach out to me on email. Otherwise, thanks for your time tonight. It was a long class, and I'll see everybody next Wednesday. This recording will also be recorded and posted on YouTube probably in the next 20 minutes. Have a good night.
Awesome. Thank you.
Thank you.